So our agenda is we're going to talk about some general information. This is kind of like stuff that you probably should already know, but I just like to go over because I feel like when I started doing the call report, it would have been helpful if somebody told me these things. Like you have to have it done on the 30th of the month, not the last day. So you don't get that call from your analyst. So balance sheet schedules, that's what we're going to do this morning. And then, oh, hold on. And then this afternoon, regulatory capital, other schedules, income statement, and CECL and other topics as we see relevant. Okay, so housekeeping, we're scheduled from 9 to 4. I am fine. If you guys want to do, I think we're scheduled for an hour lunch. If you guys want to do a short lunch, like a 30-minute lunch, and then jump back in and get out of here earlier, I'm good with that too. Nobody ever says no to that offer, so I'm assuming you guys are also good with it. We'll probably try to break around 11:30 and then pick back up at noon and then keep going. I did change the time on my computer, so I'm in the same time zone as, so that's good. Participation is going to make this way better for all of us. Call report is kind of technical. It's not the most interesting topic. I will do my best to provide you fun examples and walk through this and keep you engaged as much as possible, but interacting is helpful. And then again, if you have questions, just feel free to ask. I can usually answer most of them on the fly. If I can't, I can get you information. I can definitely touch base back with you. There haven't been a ton of recent changes on the main schedules other than CECL that's coming in March. I think we're still waiting for clean versions of CECL instructions because they're the versions we have now are if you've adopted, if you haven't. A lot of that is going to change, but I tried to put it in here in a different way so that it would be a little easier to digest. So we'll talk through that. I need to turn this off. All right, sorry. So there are changes that happened in 2020 when the CBLR was adopted that kind of snuck under the radar. So I am leaving those in there and they are in red because I want to talk through them just to make sure. I know 2020 was a few years ago, but all those changes happened in June. And I don't know if you guys remember, but there was a global pandemic and utter chaos going on. So a lot of things got kind of missed in the quieter portions. So we'll talk through those. Most of my excerpts are taken from the 051 form, not the 041. We'll talk a little bit more about the actual forms themselves and which ones to use, but we'll talk about those when we get there. But my excerpts are the 051. All right, I'm guessing you don't have questions yet. General information, the forms, the only form, which forms is everyone using? Who's using the 041? Anyone? Okay, you guys are, because that makes kind of sense. They bumped the threshold up to, I think, 10 billion, but or 5 billion. So you guys are over already or getting close to being over. Okay. Yeah, we'll talk, we can talk about that. That's actually a slide. Most of you are going to be using the 041 or the 051. I think it is really important if you are eligible for the 051, March is when you can switch over. It is, when they first brought it out, it was fundamentally the same. Now they are starting to go a separate direction. We're starting to see a little bit more changes on the 051 compared to the 041 as far as frequencies of reporting, what information is necessary. So it's starting to make it more efficient, even though it's been, years since that started. But if you're getting close to that $5 billion mark, the 041 is where you want to be. We talked about this already. Shifts in reporting. So this is going to apply to a couple of you. So the shifts in reporting are based on June 30th of the prior year, but the reporting starts in March. So for your 3/31 call report, it's going to be based on the numbers that you reported on June 30th. So to your question, if you were 5 billion in June 30th, then you have to report as 5 billion starting in March. If you go back down the following June 30th, then you're below it for the entire year. And same with your reporting thresholds. June 30th, the prior year dictates March 31st reporting. Yeah. Yes, you get another, or if you're going to cross half a billion in your financial statement audits, that's another threshold where July is probably better than June 1st, because that gives you another year to prepare. Not that you can always control that, but I know that's a game we like to play when we get to that mark. Okay, those are going to be the most of the shift, the additional reporting requirements. The thresholds are 100 million, 300, a billion, and 5 billion. So as you go through the call report, there's areas that if you're over this threshold, then you report here. And I think as you go through, it might, like as your first reporting period, you might have your call report throw an edit and say you didn't report anything here. I'm not sure if it's smart enough to do that, but that's definitely something you're going to want to do. When I'm preparing call reports, I always like to, I'm an efficiency person, so part of my job is process and improving them and automating to the extent possible. But when it comes to the call report, like I'm a pencil copy kind of person. Like I get everything put together and then I write it out on the pencil copy, and usually I have to give it to someone else to enter. So that's part of the reason as well. But the other reason I do the pencil copy is it gives me an opportunity to just kind of go through all the line items as I'm working through it and say, okay, this applies this year, this doesn't, and then cross them out to show, yes, we don't have to report that. So I think being conscious if you're on any of these thresholds is going to be important. Other general information, no more than 30 days after the report date. Retention. The call report instructions, 3 years, you're required to retain 3 years worth of call reports. And within those call reports, there's 2 important things. One, the signed copy of the call report. We'll talk about that in just a minute. And 2, the work papers. A lot of you probably have call reports going back way farther than 3 years. But 3 years is all you're required to keep. And that's right from the call report instructions. I'm going to talk about attestation. This is an important piece. And when I do audits of call reports, I'll ask for the signed page, and a lot of times it'll be blank. So I do want to just kind of mention that the call report has to be attested by the CFO who signs the cover page, as well as directors. And depending on whether you're a national or a state bank, then you have to either have 1 or 2 or 3 directors sign. And what they're doing when they sign it is they're saying that the information reported on the call report is true and accurate. And this is important because when the regulators come and do a regulatory exam and you report things on your call report, you've attested that it's true and accurate. So that gives them kind of the well, what ends up happening is when I look at exam reports, the majority of the call report issues don't necessarily have to do with preparing the call report. Like this was put on this line, this was put on this line. It more has to do with the accounting and how the bank applied accounting rules. So for example, you had a loan that was past due 95 days and you didn't put it on non-accrual. So you recognize that income. When you attest to the call report, you're attesting that you followed all the accounting rules. And in that case, you didn't. So then you get an exam finding saying that you had, this should have been on non-accrual. You overstated the revenue and now you have to go back and change it. So that's why that part's important. Accuracy is a challenge because we're only as good as the information that comes to us from our core system. Especially the larger you get, the more you rely on the core system to provide you good information. The bank in general should have safeguards and controls in place to check through that prior to it getting to the call report. So you should have your month-end reconciliation processes, check backs to be able to see that everything is reporting correctly in the general ledger compared to the applications. When we start to see a lot of manual adjustments, that's kind of an indication that maybe our data accuracy is a little bit, it could be looked at a little bit and say, all right, if we were reporting correctly, or if we were reporting efficiently, then we wouldn't have a lot of manual entries. And there's going to be manual things you can't do anything about, but some of them we should try to eliminate as much as possible, because if we can tie directly back to our core reports, it's going to be a lot easier when we go through the audit and exam process. Because really, when you're preparing the call report, you file it, and that's not the end of it. Your work papers and all the preparation, that's for us auditors and the examiners. You keep it for 3 years, but honestly, we're the only ones that really care about it after that, once it's filed. So making sure we're accurate. Couple other general items. Also, I talk real fast. If I'm going too quickly, let me know. I will slow down. It has to be prepared in accordance with GAAP. Every once in a while, there are situations where GAAP and regulatory requirements don't always match each other. That tends to happen when there's a new rule or new reporting, and then it usually gets noticed pretty quickly and then addressed and figured out. But there are some situations where it could be a little bit of a variance, but generally speaking, if you look at the call report instructions, they're going to reference the appropriate GAAP accounting for certain areas, and that's what you defer to. Amendments. I always get this question. When I look at call reports, there's usually something, most of the time it's classification. People are like, do I have to amend the call report? Well, it's based on materiality. What does materiality mean? Well, it's based on whoever cares about the call report that's looking at it determines as material. So generally, your analyst will tell you if they want it to be amended for a specific reason. If you're going through an audit or an exam, you might need to amend it, and your auditors or examiners will tell you that you need to do it. Once you go through the amendment process, you have to re-sign those attestation pages as well. So those generally will go back to the board to be signed. My personal opinion, if we're just talking about a classification error that doesn't have a lot of impact, fix it and move on. If we're talking about things that impact your capital ratio or other ratios that are going to be important, it's probably in your best interest to change it and file the amendment. Also, if it's December 31st and it's going to impact your equity. So you file your call report January 31st, you get your entries from your tax accountant for 12/31 for whatever, and you have to backdate them to 12/31. You're not going to be able to roll forward your equity on RIA if you don't amend it or enter in an adjustment for the entire year. So in some cases, it's practical to amend it. It's easier. But overall, it's kind of a judgment call. Questions on those? Okay, now we're getting to the meat. We're going to try to take a break here. It's 9:30 right now. Can someone watch the clock and flag me down at like 10:15, or when you guys all start to get squirmy because we have to use the restrooms, and we'll take a quick break. Okay, the balance sheet schedule. So one of the things that I like to talk about when I talk about the balance sheet is the order of preparing the call report. Everybody kind of has their preferences, but my recommendation when you're preparing the call report is RC, the balance sheet, and then RI, which is the income statement, And both of those feed into RIA, which is the equity roll forward. So generally, I like to make sure my balance sheet balances, my income statement balances, and my equity rolls forward before I do any other schedules, because those schedules are all going to tie back to this balance sheet in most cases. So then you know this is kind of like your source of truth that you have to work with. This schedule is only like 1 page or 2 pages, so it's not that bad, but it's a lot of stuff on there. And this is a lot more of the classification. And we'll go through the different ones. Some of these are just highlights of what most of the areas should have in them, as well as what are the common errors I see in these schedules. So assets, we start with cash. 1A and 1B are all of the bank's cash and due from balances. So 1A is non-interest bearing and currency. So this is all the cash in the bank. This is coin. This is any sort of non-interest bearing balances from your due from institutions. Generally, these are your main correspondent accounts because they don't earn interest. A lot of times when I look at these, we also kind of just, so one of the things that happens when I look at call reports are we tend to say, like, if these things are in this section on our balance sheet, we're going to report them that way on the call report. And that's not always accurate. So things like cash items, like if you're doing still cash advances or ATM settlements, while they're usually in that section of the balance sheet, they don't really belong there on the call report because they're not coins, cash, or due from balances. So some of the things that end up getting moved are cash advances. That's one. If you have other cash items that aren't actually cash, they get moved. ATM settlement accounts, like your switch accounts or your interchange accounts where the debits and credits are processing, those don't belong in cash, but the balances in your ATM actually do. And then another area is funds due from non-depository institutions. I see this occasionally where like Fiserv or Jack Henry or the core processors will require some sort of a deposit for services like debit card clearing, just so they have something to clear against in case something goes wrong. Those are not held at an actual bank or a depository institution, so they can't be classified in this group. So those get classified as other assets. And then the top one, the negative correspondent account balances. This shouldn't happen, but occasionally it could. Like if somebody doesn't run the cash letters correctly the day before or something weird happens, it could show negative. My suggestion would be to first fix it if that's an option. And if it's not fixable, it's truly negative, then it actually becomes a borrowing, just like one of your customer overdrafts would be considered a loan. Interest bearing, these are correspondent banks that have interest on them. So if you have CDs purchased from other financial institutions, FHLB accounts are usually cash or interest bearing. Federal Reserve, your excess balance account with the Federal Reserve Bank, these can either be swept overnight by your correspondent bank. Sometimes they all just go into a GL called Fed funds, but when we're doing the call report, we want to separate those out. What's actually sitting at the Federal Reserve versus what's sitting at the Fed funds. And then certificates held to maturity. How many of you guys have certificates that are available for sale? You bought them through a broker and they have CUSIP numbers. Those should be carried at fair value. And this is an interesting situation where GAAP and reporting get a little bit wonky. Under GAAP, those securities, those CDs can be exchanged. So they're considered an investment or an investment security. So they have to be marked to market, just like your investment securities. But on the call report, we report them as cash because they're truly cash from the call report instructions. So there's situations like that where We just kind of have to make sure that we're reporting them appropriately. This one, I don't know that a lot of people have these, but if you have like MPF programs with Federal Home Loan Bank, and you have your checking account at Federal Home Loan Bank where the deposits, the customer payments get put into that account, it's swept there, and then the FHLB pulls it out. Those funds are technically not due to the bank, they're due to the FHLB, so they shouldn't be included in your due from balances. Okay, securities are usually straightforward. Does anyone here not have bond accounting reports that they use? Most I can't imagine like banks your sizes doing that by internally. So most banks use bond accounting reports, and the beauty of the bond accounting report is they just give you all the information. All you need to do is make sure it reconciles to your general ledgers and your information, which should be done at the month-end process anyway. So it's pretty straightforward. The bond accounting reports come in different shapes and sizes, so they might look a little bit different, but generally all of them have call report schedules and risk worksheets or RCR schedules if you're still doing risk ratings. There will be some CECL changes potentially related to securities. We're going to talk about those in a little bit. But it could potentially impact, probably more likely the held to maturity than the available for sale, but we'll talk through those when we talk about CECL. How many of you guys have equity securities with determinable fair market value? Okay. This is something that changed in 2019 and people are still struggling with it. Farmer Mac stock tends to be the biggest one. So if you have like the mark to market Farmer Mac stock, that would get under here. If you have mutual funds, if you have any sort of equity-based money market type account, that would all go here. And the main thing with this, just in case it comes up in the future, is starting in 2016, we had to, prior to 2016, we reported these as other investments and we ran that unrealized gain or loss through AOCI, just like we would for our securities. In 2016, they said, nope, we want that to be ran through the income statement. So it's a recognized unrealized gain or loss. So you're truly reflecting the balance of equity securities when you are running those entries and marking them to market every month. Fed funds sold. I feel like these go in cycles. My guess is about a year ago, you guys were selling crazy amounts of Fed funds. And recently, that's probably not so much the case because we've kind of shifted the liquidity. Fed funds sold are very specific and they get reported out on item 3. Item 4, so practically speaking, when you're doing your worksheet, you can enter 4A, loans and leases held for sale. And you can enter 4B and they have to tie out to RCC. So this is one of those areas where we just want to make sure all of our numbers agree and they tie out. Loans held for sale. Again, if this was a year ago, we would have been having a very different conversation because you would have had, if you were selling loans on the secondary market, you would have had huge amounts of these. And the questions would be, you know, how do you identify them? How are they coded? How do you know what's for sale and what isn't? My guess is there aren't nearly as many of those right now. Probably still some, but that's gotten a lot more manageable. These are generally 1 to 4 family residential loans that are going to be sold to Fannie, Freddie, FHLB, other investors. 4B is loans and leases held for investment. And these are going to be all the other loans that the bank intends to keep on their books. 4C is the allowance for loan losses, and we're going to talk about how that's going to change for most of you. So it's kind of a spoiler. most of the banks, it's not really going to be a huge impact. It's going to look and feel the same. There's just certain scenarios where reporting could change when it comes to the allowance in CECL. We'll talk through those specific areas, but I think we've kind of gotten all worked up about CECL, and it's not going to be as huge of an impact as a lot of people think it is once we make that entry. And I'm sure all of us will be happy to just go a few months without talking about CECL, because I feel like we have been talking about CECL since like 2015. This is like, we're over it. Let's move on. And it was funny because up until like November, I still had quite a few banks that were in denial. I did CECL modeling in January for some banks because they're still like, no, this isn't real. I'm like, no, it's real. We're gonna have to do this. Trading assets, those are pretty rare. I'm assuming none of you have trading assets. You do. Interesting. So there's not gonna be a lot of slides on trading assets, but if you need information, we can talk more. Premises and fixed assets, these are everything that's not software. So if you have software commingled in here, pull it out. That gets reported as another asset. This one is one of my favorite ones to talk about. Anybody have anything you report as original paintings, antiques? So I have this bank in Wisconsin up near Green Bay, and the president who took over, the CEO, I think, he took over and decided that the bank wasn't a place that people wanted to come, and he remodeled the whole bank and decided to make it kind of like a community art gallery. So he went out and bought like local artist stuff. And this always sticks out for me because the one day I was walking to the boardroom and there's like a glass case and there was a like Mr. Coffee coffee pot with a custom made yellow raincoat and rain hat. So this was, and so now looking around this building, I see, okay, you have all this artwork. So that would be assets that would have to be separated out. Those don't get included with the fixed assets or premises. They go to a special group if you have any other things of value that wouldn't be like normal use. Other real estate owned. This has been quiet for a while. However, I feel like I'm starting to see more ORE getting reported. And I feel like in the next few months, that's going to start to grow. ORE is one of those areas where you really kind of, does any of your core keep track of that, or is that all a manual process for most of you? Somewhere in between. The trick with the ORE, and we'll talk about it when we get to RCM, is that you have to report it based on what the loan was when it was an actual loan. So if it was 1 to 4 family closed, you'd report it as 1C2A. When you report it as ORE, even though it's no longer in your system, it's in ORE, you still have to report it based on what its loan classification was. So that can get a little bit tricky. I think generally we're out of practice with ORE. Any of us been around in like 2009, 2010, probably remembers how much ORE was around at that point, and we're going to probably have to ramp back up to that. Number 8, does anyone have investments in unconsolidated subsidiaries? These are pretty rare as well. Usually the subsidiaries of banks are generally either consolidated or they're separate from the bank completely through the holding company. Number 9, direct and indirect investment in real estate ventures is also pretty rare. Number 10, intangible assets. We'll talk more. These tie out to RCM. So these are important. These are going to be your core deposit, your goodwill, and your mortgage servicing rights, and a few other things. We'll talk more about those. And then all other assets. So we're going to jump really quick. Any questions on the balance sheet? We're going to jump quick to RCF, other assets, and go through this one. This is usually pretty straightforward. Accrued interest receivable is just one giant number, so just group all those GLs together. Item 2, if you have a deferred tax asset, this is an important one. It causes a lot of confusion. If you have a deferred tax asset, it has to be net. So if you have asset and liability accounts, it nets to a deferred asset, you report here. If it nets to a deferred tax liability, you report on RCG, which is other liabilities. Right now, because of the unrealized losses within the investment portfolios, I would venture to guess most banks have a, if you have available for sale securities, you likely have a net deferred tax asset. If we're in a big gain position, it would be the other way around, depending on your other amounts. I sometimes see federal and state taxes accrued included in this amount. They do not belong in this amount. Those are truly accruals. This is only the general ledgers related specifically to your deferred tax. Interest only strips. We saw a lot more of those in the past. We don't see them as much anymore. Item number 4, equity investments without readily determinable fair value. So these are different than the equity we saw on the balance sheet. These are going to be things like your FHLB stock, your Farmer Mac stock that is Class B. If you have stock in your correspondent bank, Federal Reserve Bank stock, any stock that you can't go to a market to get a value on right now. BOLI, how many of you guys have BOLIs? BOLIs can be different categories, and when we moved to Basel III, this came along. A lot of them are general account policies, but there are separate and hybrid accounts. And how would you know this? You usually get either a monthly or quarterly statement from your insurance company, and it will break down which part is which. And then all other assets. This gets reported for the 05-1 semi-annually, I believe, and the 05-1 it's annually, if I recall correctly. And this is anything that is greater than 100,000 that exceeds 25% of your all other assets. So they're saying if you have a big amount in your other assets concentrated in a specific area, they want you to call that out. There are some specific items on there like prepaids and other fair value of derivatives, things like that are already written out. But if it's not on there, you can write it in, and you just want to make sure that whatever you put in that box is clear and informative, but not too much information. So like if it was deferred comp for John Smith, you're just going to want to put deferred comp and leave John Smith's name off because this is public and everyone can see it. And if you do accidentally put something like that in there, the analyst will probably call you and tell you to refile so that it gets cleared off. These are some of the common items. Non-real estate repossessed assets, these aren't as common. Banks don't tend to like to repossess cars and things like that, but if you had any of them, they would be there. Software and accumulated amortization, credit card cash advances, anything that doesn't really have a home. And this you do want to be careful with because this isn't just a dumping ground because we don't know what to do with that GL. Generally, when I look at the call reports, I'll look at what's in other assets and I'll ask questions. A lot of times they might belong somewhere else. Again, they're just put in that section on your balance sheet. So we just report it there, even though they probably don't truly belong there. Some examples, every once in a while, I'll see like loan non-post or something like that in that section. And those really belong with the loans, not with the other assets. And then the total, your total assets on your call report might not agree to your total assets on your balance sheet. And that's okay because you might have to make adjustments for the deferred tax. You might have to move assets to liabilities or vice versa, depending on the situation. But generally, if they don't tie out directly, my recommendation is to do a quick reconciliation to show exactly why. You moved this account here, you move this account here, you can tie it all back between the two. The reason I say to actually do that is because 4 months later, when your auditors or examiners come, you're not going to remember what you did, and it's going to take you a while to figure it out. So just building that into your process is, one, going to help you make sure that you tie out, and two, it's going to be good support. I think that's the questions. All right, liabilities. This is probably the easiest part of the call report. Deposits are, they are always a little bit of a challenge because we have to, how we have to slice and dice them. But for the balance sheet schedule, most of the time we put them on our balance sheet as interest or non-interest in the general ledgers. That's the easiest way to do this. If not, there's likely some internal report that you rely on that's going to tell you what's interest bearing and what isn't. And this is just out of everything. So really the non-interest bearing is primarily going to be checking accounts, just basic checking accounts. Anything that earns interest gets reported in 13E2. Fed funds purchased. Fed funds purchased are pretty straightforward too. We're starting to see a lot more of those now as people are trying to like keep up with liquidity. The daily Fed funds are becoming more common than the Fed funds sold. Usually it could be you have nothing, or it could be you're borrowing, or it could be you're selling. So right now, I think we're kind of in a position where I'm seeing a lot more Fed funds purchased than Fed funds sold. 14B is securities sold under agreements to repurchase. Does anyone still do repos here? Repurchase agreements? That's where these would go. These are a little bit interesting to wrap your arms around, because what ends up happening is a repurchase is, it looks like a deposit on our balance sheet, but it's really a borrowing because of the way that the repurchase agreements work. At the end of the night, the customer owns the security and you own the cash, so it's considered a borrowing. That has a bigger impact when we talk about risk-based capital later on, but and it's important to separate those out of your deposits for like your FRY 2900 reporting to get accurate deposit amounts. Trading liabilities, so you guys would probably have these as well. And then other borrowed money, and these tie out to RCM, so we'll talk about them when we get there. 7 and 18 aren't used. 19, subordinated notes and debentures. So generally, the sub-debt for banks is done at the holding company level. It's pretty rare that I would see an actual bank issue sub-debt. So when it's done at the holding company, you don't report anything here, but that pushes down into your equity. So it ends up in your retained earnings, and that's where it shows up in your balance sheet. So I do get a lot of questions about that when the holding companies issue sub-debt and it gets pushed down. Where does that go in the call report? Well, if it's done at the holding company, it doesn't go in this section of the call report. And sometimes if you're working on both the holding company and the bank, it gets confusing between what goes where. So we're seeing a lot more sub-debt being raised too. In the last year, though, I've seen quite a bit more than I've seen historically in the past. And then other liabilities, we'll jump over to RCG. It's kind of the same cadence as other assets, interest accrued and unpaid, other expenses. And this is where we put those income tax payable. You have the net deferred tax liability, it goes here. If you report something on both RCF and RCG number 2, you're going to get an edit. It's going to tell you that's wrong because it knows one should be 0 and one should have a number. This is this is something that's becoming more pronounced with CECL. We've always had allowance for credit losses on off-balance sheet exposures. It's been more of an optional. We don't have to really do it if it's not material, and to some extent that applies to CECL as well. But there is specific requirements with CECL to be able to have an allowance for your unused commitments. So now that should be part of your CECL calculation, is this unused commitment section. That does not get included with your regular allowance. That gets reported over here as an other liability. And then also the other liabilities, any of those random accounts, there's not typically a lot of them. Generally, it's the accounts payable, the deferred comp, and if you have any dividends that are declared but not payable, those are usually the bigger items that go in there. Again, if you have non-post deposits included in there, those really should be with your deposit section, or anything that's, take a look at them, make sure they're all like really appropriately supposed to be there. This is interesting too. So there's certain things that are in your liability section that might be a general ledger account, but they represent a deposit liability technically. State or federal withholding taxes, most of the time I see banks having these in checking accounts, internal deposit accounts, but periodically I'll see a general ledger. And if it's in a general ledger, it should be reclassed to deposit liabilities. Escrow of any kind. Sometimes, most of the time, your actual mortgage escrow is in your deposit system, so you don't have to worry about that. But if there's like escrow for a down payment on something or some other type of escrow account, those get reclassed to deposit liabilities. And then any of those collected payments that need to be remitted, which also normally sit in an internal deposit account. Again, they may not agree because of adjustments, document, and retain the support. Equity capital, that's the last part of the balance sheet. Generally, this comes directly from your balance sheet. It's pretty straightforward. So I don't want to take a lot of time talking about the specific items. What I do want to take some time for today to talk about is what is equity / capital, because this has become a hot topic in the last couple of months because of the unrealized loss position and the impact of the AOCI. So when we talk about capital and equity, those terms are used interchangeably. There are different applications depending on the specific calculation. So we have, and really sometimes you have to go back to the rules to figure out what equity or capital truly means, what the definition is. So I just have Wisconsin here because I'm from Wisconsin. So the state of Wisconsin has a definition of equity, and it looks similar to the federal definition, but it actually is different because in the state we have, it says less intangible assets. So for the federal purposes, we only take out a threshold deduction for your mortgage servicing rights. But for the state, they're saying you have to take all of that out. So there could be differences based on the definition of capital. And why does this matter? Well, this is the number we use to calculate a lot of other things like the legal lending limit specifically. So we need to kind of understand what those definitions are. So even beyond that, there are other applications. So we have what our balance sheet capital is, and that's what the directors see. That's what our financial statements say. That's what gets reported on RC in the equity section. But it's not really the calculation that gets used for anything else. So the calculations that get used for other things are tangible capital. So tangible capital is important because this is what Federal Home Loan Bank uses to determine if we're eligible for our borrowing line. So with tangible capital, what we're doing is we're taking the capital numbers, we're keeping the impact of the AOCI, which could be, that's the part that's causing pain right now. And we're also subtracting out any intangibles. So this amount is going to be quite a bit lower than what your regulatory capital is. And it's going to probably be lower than your balance sheet capital because we're recognizing the impact of any intangibles on it. And then regulatory capital is what we're going to talk about after lunch. And this is the capital ratio we use to calculate, or the capital we use to calculate our capital ratios. And most banks have elected to opt out of including AOCI. So this capital amount is going to be significantly higher than your tangible capital currently if you have large unrealized losses on your investment portfolios. AOCI has been a big issue the last few months. AOCI is connected to the unrealized gain or loss on your available for sale securities, and it's line 26B. And this is important because this does impact your tangible equity and it impacts your balance sheet equity, but it does not impact your regulatory capital. So there's been a lot of conversations about, okay, the unrealized losses are getting so big. How is that impacting the bank? Well, as far as regulatory capital, it's not impacting you at all. As far as tangible capital, it could be. And then kind of the same cadence here on the balance sheet, it gets included with your capital, your final capital on the call report, it gets backed out. And generally speaking, AOCI is the difference between your fair market value and your amortized cost of your available for sale securities. Now, there's situations, if you have the deferred tax asset, they might not equal, or if you have CDs, they might not equal. I do see quite a few edits if you have CDs that have AOCI because it doesn't match and it's confused and doesn't know why. So you just have to send them an explanation. A few items with balance sheet, just making the adjustments. It's always a good idea, even if your call report is mapped or interfaced, to go through your balance sheet and make sure everything is reported correctly. Some accounts may need to be reclassed, and I think you can do that on a materiality basis. Contra accounts stay where they are. For example, in this case, these are participations that net against the total loans. They would stay. We wouldn't reclass those. But for example, this building maintenance, this does not appear to be a liability. It needs to be reclassed to an asset. But before I just reclass it, one of the things I would do is say, why is that happening? Should there be an entry that clears that so it's not there? There could also be situations where your balance sheet was set up in a way that doesn't agree with the call report necessarily or align with it. This is an example of one of the banks I worked with that, and I see this every once in a while, for whatever reason, at some point people put the allowance with their equity on the balance sheet. Not sure why that happened, but I do see it kind of frequently. If that's the case, that needs to be moved to the balance sheet and net against the loans. And then we talked about the deferred tax and just making sure that any adjustments are documented. Any questions on RC? Okay, RCA is the 401 form only. So these are 3 million or more, 300 million or more, report this. And it's really just taking that cash section on RC 1A and 1B, and then specifically including like what's physically being held at the bank, what's a due from, what's sitting at the Federal Reserve. So it's just breaking it down in a little more detail. Okay, we're gonna go through securities, I think, and then we might take a break. Securities are pretty straightforward. Again, you have bond reports that do most of the work for you. As long as you're reconciling them, you should be good. I will say that if you get a preliminary report, you're gonna wanna make sure you true up the unrealized gain or loss at the end of the quarter to match whatever your final bond report is. Did any of you guys reclass available for sale to held to maturity? You guys didn't completely go off the deep end like just about every bank in Wisconsin did. And even though I said it was a terrible idea, reclass everything and now have like 15 years worth of accounting nightmares to deal with because, okay, good. We're not going to spend a lot of time on this then. This is something where we've had, when you start to get to the point where the AOCI is so large and your tangible equity is creeping towards zero, banks are getting calls by the Federal Reserve. And as they went closer to zero, as they hit zero, their lines were being frozen. So they were losing the ability to borrow. There's also some Fannie Mae guidelines that require certain things to happen with AOCI. So some banks are in a position where they actually had to kind of stop the bleeding by moving available for sale securities to held to maturity. That option is on the table, but once you make that decision, you can't really undo it because if you move it back to available for sale, you've tainted your portfolio under most circumstances and you have to mark everything to market. So that's kind of one of the things that's been going on right now. What ends up happening is you don't eliminate all of that unrealized loss, you just strand it and it gets amortized off the life of the security. So that's a lot of accounting for a long time and it's not clean. And every bond report is different on how they give you that information. If you can avoid doing that, you should. Pledge securities. Depending on your bond report, sometimes I think Stifel, Binding Spark does it where they actually do this for you. Most of the other bond reports give you either the amortized cost or the fair value. So if you have a mixed portfolio, you need to know which one to put in this section. So if it's a held to maturity security, it gets reported at amortized cost. If it's an available for sale, it gets reported at fair value. And for the maturities and repricing, these all need to tie out to the previous items. So if they don't, you know that maybe you took the wrong column or grabbed the wrong. If you're using your bond report, it would just be the wrong column. Held to maturity securities sold or transferred to available for sale during the calendar year. This needs to be reported. There are legitimate reasons where you can do this without tainting your portfolio, but you should really be careful with this one. And then structured notes, if you have any of those, they are generally on your bond report. You guys have available for sale or held to maturity? Anyone have available for sale? Mixed? Held to maturity, just? Okay. Let's take a quick break, I think. Want to do like a quick 5-minute restroom coffee refill break? We'll come back at, let's just do 10:10. And then we'll keep going with RC.
a week at the end of this month where I have to do the same way. 2 in person and 1 as a webinar for the month. And we have to make it. I don't know why I read these things. It seems like a really good idea. There's water. Think?
Copy.
Okay, now I have a whole. Okay.
Okay, so we're gonna start talking about RCC and RCN. I like to do these two together because they really I do them together when I'm doing the call report, sometimes because the reports are the same and it's just sufficient to do it that way. And they're definitely related. And I'm gonna have really cool news about these schedules here if you already don't know, so you'll have to wait till the end. So loans and leases, the first question is what gets included? So obviously all of the loans get included and all of the leases get included. But in addition, any unplanned overdrafts are considered loans and any non-post suspense or clearing accounts. Generally, we should probably be taking a look at these accounts to minimize any manual adjustments, clear them out to the extent possible. Sometimes that's not always possible, but the fewer loans you have sitting in these non-post and suspense, the less you have to deal with them at the end of the month. There is wording about materiality, like if it's material, it should be reclassed, but most of the time it's a handful of loans or you have to figure out somewhere to go with it. Either way, it's going to create additional adjustments you have to make on maturities and other areas. It's going to make life a little harder. So the cleaner that is, the better. No, not really. Like, it depends on this. It really kind of depends on the size of the bank. Like if you have if you're a, $5 billion bank and you have a $10,000 loan that isn't reclassed, who cares? Like, but if there are larger amounts that could have an impact, and that's kind of like the way I normally think about it is it going to move a ratio? So like these loan ratios are used for other things. Is it going to have a significant impact on that loan category that could skew somebody's understanding of your information? Yes. So it would be like what ends up on the UBPR because that's what's being used by the public and the regulators in a lot of cases to take a look at the bank. So it could impact your concentrations as well. It could impact some of those. It could impact your allowance calculation. So if it's going to be or maybe that the majority of the loans that are in the non-post or the suspense accounts are 1 to 4 family. So you just reclass them to 1 to 4 family. It's generally just a good idea to have those accounts cleaned out as much as possible. So you don't have to worry about big amounts and then less questions. But yeah, I generally, if it's going to move a needle, that's when I start to think, okay, should it be redone? No, generally, I would say like from a capital perspective, you could probably apply this across the board. If it's more than like 25 basis points, you probably want to, it's impactful. But again, it depends too. Is it your 12/31 call report? Is it your June call report? Are you going to have an exam or are you going to have an audit where people are going to want to see all those details? Like, and it depends on who's looking at it. Like it does say in the instructions, if it's material, it should be moved, but you might have people looking at it that take a hard line and say, you need to move it. There's no materiality. It depends on who's looking at it. And this is just an example of like the loans in process. I have one bank, they're quite a large bank. They're like I think a couple $2 billion, and they have every single item in their non-post account. And there sometimes is 20 of them. Some of them are under $10 are getting reclassed. which that seems a little bit extreme for the size of the bank. They probably don't need to go through that much trouble. But then the other question is, what do you do with it if you don't reclass it? Where does it go? You have to put it somewhere. So, FAS 91, it's now ASC 310-20, which everyone knows FAS 91. FAS 91 non-refundable fees and other costs get net out of the loan categories ideally. If you don't know which category they're associated with, like 1 to 4 family, you can report them in item 11 as a total amount. But again, it's better if you know what they are to report them. I probably could get rid of this PPP loan stuff, but what we were finding is sometimes these deferred loan fees are, instead of being a contra asset, they're being reported as liabilities, and they really should be net against the loans. Okay, so this is RC, all the schedules. Items 1 through 11 are classified based on a specific priority, and we'll go through each one of these, but the priority is, if it's a lease, it always gets reported as a lease in item 10. If it's a loan to a state or political subdivision, it doesn't matter what the loan is for, what the collateral is, what the purpose is, it always gets reported on item 8. If it's secured by real estate, it always gets reported in item 1 based on the type of real estate. If it's based, items 2 and 4 and 6 and 9 actually are based on the borrower and or purpose. So consumer or depository institution or purchase a car. So we'll talk through those as well. And then other. So 9B is other, and there is very specific things that go in that group we'll talk through. That's not what I a lot of times see in the other category is loans that people don't know where to put. Like they really truly belong somewhere else. We just don't have coding to tell us where they appropriately belong. So we kind of just throw them there. Okay, so leases and lease receivables, these are, if you have leases, they're usually segregated out into a separate type code or GL or some way. Obligations to state and political subdivisions. These are state or local governments, municipalities, subunits, as well as Native American tribes. All of these will get in this category. And if you're doing risk-based assets for your capital calculation, this does have an impact there because you can lower the risk weight on these types of loans. So that'll show up again when we get there. This is an interesting conversation. If you're doing lending directly with a municipality, sometimes what we think is a loan might actually be a debt security. So it's important, if you have those type of arrangements with municipalities, that you look at those loans. There's specific requirements that have to be had in order for it to be considered a loan. The main one is that it's not traded on a market, obviously, and it's not divisible into groups. So for example, if I was a municipality and I issued and I did a loan with you, I would be the only one that had the entire loan. But if I issued a debt security, I could sell parts of it to different banks. So it's how it's kind of broken up. Loans and leases secured by real estate. I would say a good portion of your loans are going to be in these groups in item 1. Mainly the collateral here has to be held with some sort of a mortgage, a deed, or a land contract. You guys have weird stuff in Michigan, like land right. You don't have anything like that, where there's some places, mostly out west, I see where people they buy stock in a subdivision. So their house is in the subdivision that they buy stock in, but they don't actually have a mortgage or own the property. So those get a little bit murky. Seriously, you get past the Mississippi River and banking gets completely bananas. Like, I don't even know what some of this stuff is that's going on out there. But generally speaking, in most cases, it would be a mortgage, a deed, or some sort of land contract. The liens, it doesn't matter what position the lien is. It doesn't matter if it's residential or commercial. It doesn't matter if it's guaranteed or not. The main thing is that the real estate is the primary collateral. Now, sometimes with commercial loans, they a bunch of collateral. And we'll talk about this, like how do we classify this loan? Is it real estate? Is it commercial industrial? What do we do with it? Or we have a building that is, it has 2 apartments and a storefront. So it's definitely real estate, but is it 1 to 4 family real estate or is it commercial real estate? So we'll talk through kind of the classifications there. The main thing is the real estate has to be the primary collateral. When there are situations where, we just kind of take that mortgage as an abundance of caution because we have like the 15 on it and it just makes us feel warm and fuzzy. That doesn't count here. That's not going to be a real estate loan. Okay, so once we get into the real estate loans, we start to break them down into smaller groups. The first group is construction and land, and these are broken into, these are any sort of land development, construction, vacant land that's not being used. There's definitions of what construction means, but this is generally any sort of not commercial real estate, not 1 to 4 family real estate and process type. This is broken into, I do want to talk about this. This is creating an issue with CECL. So even though this is a call report training, this is a CECL issue. So if you're doing the WARM method and you're going back and looking and you have these construction loans that become permanent, we're keeping the type code. I believe in a lot of cases, we're just keeping it and changing the loan to permanent. So it's making the tools for the construction super wonky because it's showing more loans than are actually in there because those loans were moved to different buckets because they became permanent financing. So this is something that doesn't happen in the accounting function. It happens in the lending function, but it impacts what we report. So if we have construction loans and they're moving to permanent loans, we want to make sure there's a process to kind of physically move them into that different type code so they get reported appropriately and they don't cause us any sort of CECL issues. This is just some more information. So the 2 groups here, it can either be 1 to 4 family residential construction or any other vacant land or construction, commercial construction. And this one gets a little bit confusing because I get a lot of questions like, okay, the property is vacant right now, but it's going to be used for 1 to 4 family development. Okay, well, I mean, the amounts in these buckets aren't that big. Just, I guess, use your judgment, document it, and move on. Some of these are going to be a little bit blurry, so you're going to just have to be consistent on how you apply that process. This is important. Do you guys have a lot of ag loans in this area? Not ag lenders. Yeah, so vacant land could be ag land potentially, so you just want to make sure it's not an ag purpose. Although you guys could have a different ag purpose than we have in Wisconsin. Like there's a lot of stuff that fall under ag, like cannabis production, which is a thing here, as well as harvesting trees, which is like an upper, more rural area. So there are other things that aren't necessarily related to cows and corn that are considered ag. And then that leads us to secured by farmland. And a lot of times I would just like the easiest way to look at the tax record. If it says it's got tax credits for ag, it's probably ag land. 1 to 4 families. So the 1C group is specifically all of the loans that could go to 1 to 4 family. And these are anything that has properties with 1 to 4 units. One of the questions I get is, we have a loan and there are 6 duplexes, so 12 units total. So 6 duplexes, would that be multifamily or would that be 1 to 4 family? So it's 12 units total, 6 duplexes. Thoughts? It's still 1 to 4 family because they're 1 to 4 family units. Even though there's more of them, they're still at their base. Each one of them is a 1 to 4 family unit. So those get a little confusing when we look at that part. Multifamily, which we'll get to, is actually 5 or more units in one building. Mobile homes are a little bit weird. There's state specific requirements, sometime, and they're very detailed to the locality. Normally, if there's like an axle of any kind and it can be moved, it's not considered a mortgage, it's considered a consumer loan. If it's on a foundation, it's considered a 1 to 4 family. And condo units are 1 to 4 family, and non-farm, or multi-use, that would be the example of the apartment. There's 2 apartments and a commercial space. You can, whatever the primary use is, and you can use your own metrics to determine that. Is it square footage? Is it revenue? What is the criteria that you're going to determine what the primary use is? It could be that it's commercial and they just so happen to have 2 apartments. It could be that the commercial unit is small and the apartments bring in the amount of revenue. So this is one where, again, just apply the whatever is more than 50%, apply consistent criteria. 1C1. So these are 1 to 4 family, and these are 1 to 4 family that are open-ended and revolving. So these are HELOCs generally. Does anyone have HELOCs that go to, your customers can convert their revolving HELOC into a fixed rate loan? So those are a little bit confusing. This is a new rule from January of 21 where you do have to, you continue to report them as HELOCs, but on one of the memoranda 16, you have to report the ones that were converted. So having a mechanism to be able to do that is a little bit tricky, but okay, and then the last 2 1 to 4 families are the 1C2A, which is if you're kind of a community bank, regular consumer type lending is going to be a good portion of your loans, the 1 to 4 family first liens. And then 1C2B are like what we know is like home equity loans. They have fixed rate, fixed term, and usually a junior lien position. Multifamily, these are any 5 units or more, apartment buildings, co-ops with 5 or more units, anything that isn't 1 to 4 family, but it's also not commercial. I know for CECL, a lot of the banks include this with their commercial real estate, which makes sense because it's really not consumer anymore. It's more of a commercial real estate, but it has its own category. Then we get into the commercial real estate, which is the E1 and E2. A long time ago, there used to be just E1, and then that got broken down into owner and non-owner occupied. These are commercial real estate, any sort of real estate that is being used for a commercial purpose, a not residential purpose goes here. There's always questions about owner occupied versus non-owner occupied. And really it comes down to what the cash flow is. Owner occupied means that whoever is in that space owns the property and they're generating the revenue to be able to pay the mortgage. Non-owner occupied is when there is revenue coming from a rental. So I own the building, but you rent it and pay me, and I use that to pay the bank. So that's non-owner occupied. And there are specific examples that are kind of weird, like hospitals, golf courses, rec facilities, car washes, specifically reported at 1E1. And on the same token, hotels, motels, mini storage, assisted living, those are non-owner occupied by definition. This is really small up here and it's in your notes, but it's kind of a nice flow chart as to where it belongs, like a yes, no. Where does it get reported for real estate? Any questions? Okay. Loans to depository institutions are number 2. I don't see these very often. We don't really have a lot of banks lending money to other banks. So these aren't super common. 3 is ag production. So this is any ag purpose without real estate. Since I live in Wisconsin, that's actually one of my pictures on my phone. Number 4 is commercial and industrial. So this is any commercial loan that is not real estate secured. It also includes credit cards if they're readily identifiable to commercial customers. So if you have a really big credit card portfolio, you probably want to pull out the commercial ones from the consumer and be able to report them here so it's more accurate. This does not include loans to nonprofits. So if you do a loan to the Boys and Girls Club and you don't secure it with real estate, it would not get reported here because it's a nonprofit. That would get reported as an other loan. It's one of the few items that appropriately goes there. Number 6 is consumer loans. And then consumer loans are broken into subgroups. The first one's credit cards. If we can't identify the commercial, they probably end up here, but if we can, that would be better. Revolving credit plans. So this would be like your ready reserves or your overdraft protection or any sort of revolving consumer. It does not include unplanned overdraft. Those are also considered other loans. So this only includes lines that are set up specifically with notes and all the appropriate documentation. Automobile loans are 6C. These are for the purpose of purchasing an auto loan. They do not need to have auto loans as collateral. Like you could use your boat as a collateral to take money out and purchase a car, and it would be considered a car loan, even though the collateral is a boat, which makes things a little bit confusing. So you do have to rely on the purpose code. And then loans for business vehicles are commercial and industrial. They're not a consumer purpose. Now, when we start to get into like, you know, my Uber driver yesterday, his Toyota Camry, is that a commercial loan or is that a consumer loan? I don't know. I don't know. I would assume it's still a consumer loan because it's his vehicle. He's using it for a business purpose, but it's probably his primary vehicle. If he has a fleet of Uber cars that other people drive, I guess, then I would make it commercial. But for now, I think we're still considering those consumer. Other consumer loans are pretty much any other loan made to a consumer for anything else that we didn't already put in there. 9, this is the kind of catch-all and the oddball stuff. 9A is loans to non-depository financial institutions. We do see these a little bit more. This would be a loan to a holding company, insurance company, finance companies. There's a bank up in Wisconsin that specializes in doing loans to holding companies. So in a lot of cases, that would be if they want to do some kind of a leverage purchase of another financial institution. Or just increase the capital that they want to push down. Those are some scenarios there. And then all other loans, the main things that go in here, there's a bunch of things that go in here. They're all super peculiar, but the three more common ones is overdrafts, unplanned overdrafts, doesn't matter who the overdraft is with, nonprofit loans not secured by real estate, and then any loans for the purpose of purchasing and carrying securities, which most of the banks don't do. You probably don't want to do. And then number 11 is just any of that FAS 91 deferred accounts that can't be allocated in the specific loan groups. We just talked through this a little bit already, so we don't necessarily have to do this. It's just an example of like how you would kind of work through what loan category it is. A lot of times you'll get these calls because the lenders or the processors might not know. One of the things we do want to talk about this loan coding and starting at originations. One of the things that has been coming up more frequently, I've probably gotten involved in a couple of MRAs in the last couple of years, and a lot of conversations is this data integrity. What we're finding is, as the auditors and examiners are looking at the call reports and looking specifically at loans, and usually this comes from they look at loans, then they tie it back to the call report and they're not able to do that. So they realize that loans are potentially not coded correctly. And then they start digging in and we find that it's probably a much bigger issue than what we even thought. So one of the things that I strongly recommend is, it's garbage in, garbage out. So if we're looking at the loans that we're getting on our reports, we need that to be reliable data. So in order to vet that out to make sure it's reliable, my recommendation is to have some sort of procedures in place to make sure loans are being coded accurately. Some banks do a periodic scrub of their loan download. Some banks have like a monthly review. Somebody looks at all the loans that were originated and says, yep, that's correct. Yep, that's correct. There's some sort of process in place to make sure that loans are being booked at the appropriate call codes. Because again, that goes to those amounts that go to the public information. We look at them for concentrations, we look at them for the allowance. There's some that tend to get like, if I do a loan scrub, I will get like fundamentally like systemic issues with certain groups. So for example, I'm an investor. So I'm a commercial customer. I go to the commercial lender. I'm buying a 1 to 4 family rental. It gets put on the books as commercial real estate because I'm a commercial lender. I'm getting a commercial loan. This is a commercial property from the way that they think about it. The reality is the collateral is 1 to 4 families. So that's really not commercial real estate. That's 1 to 4 family real estate. So now we are overstating the commercial real estate, which is more risky, and understating the 1 to 4 family, which is less risky. So it's those types of things. It's important to have a handle on it to make sure we're doing a good job. I would also say too, that if you look through your loan type codes and you see anything that's called miscellaneous or other, there really are no miscellaneouses or others. It has to go somewhere. Like that code should be eliminated because they're really not miscellaneous. Like they're something. So they have to be put where they actually belong. So whenever I get involved in these projects, the first thing I do is get rid of any of those miscellaneous or other codes. Same with collateral, miscellaneous or other. You can't have, like, you have to have a collateral. It's got to be something. So that's my 2 cents on that. That's a little more information. Call report instructions, I know can be really intimidating. Does anybody look at them when they need to? Couple of you, okay. They can be intimidating and sometimes you read them and you wonder if this is because they make no sense at all. And they're like, okay, to do this, you have to look here, you have to look here, you have to look here. And then we're going to say something else that sounds completely the opposite of what we just told you. Yeah, it is a struggle. However, I will say for the loan section, I think these are pretty good. Like the RCC instructions are really clear. And I can also say I am positive of this in the last, I would say 6 years or so, they've been working really, really hard to make the call report instructions more clear to your point. What I'm finding is they must be reacting to questions that people are having, which is something they didn't really do before, because I'll have a slew of the same questions all in one quarter. And then the following quarter, I'll go into the instructions and it's specifically addressed in more plain language. So I think they're really starting to take a step back and say, you know what, if we talk to people in a language they understand, there's a better chance they're going to do what we're asking them to do because it makes sense. So I have seen more and more that they're being responsive to questions, they're addressing confusion, they're clarifying. So give the instructions a chance. Run over there if you need them, check them out. They can be your friend. Okay, we're not going to do this loan quiz, but if you go to in your stuff, there's information about some examples of what the coding would be. Okay, memoranda. So we're gonna skip 1 through M1 through M1G, which is the TDRs, because that's gonna be a little bit different discussion. And we're gonna go right to the repricing. So one of my least favorite areas of the call report to do is the loan repricing. It doesn't matter if you have core system reports that spit out exactly what it is that you need. Somehow this creates all kinds of problems because all those adjustments you have to do along the way. There may be situations if you've just gone through a merger where you have to allocate fair values, discounts, premiums. You could have those FAS 91 fees that have to be spread across these. So it's not always as simple as just saying your core report is printing. This is, 1 year, 3 years, 5 years, and so on. There's some adjusting that needs to be done. I think that having a worksheet set up to help you do this and make sure they balance is really helpful. Because then you're not chasing edits when you get to the end. It's easier to deal with it as you're doing it. Most of the time, I would imagine all of you actually have a starting point report of maturities that you can reference. I have worked with some banks who don't even have that, so you actually have to go in, use a file and figure it out, which is even more of a challenge. This is a frequent edit. Again, just check backs, make sure you exclude the non-accrual. Some of the reports from your core system exclude them, some of them don't. Just make sure you understand what the reports are doing. This is information that every bank who exists on the planet needs to report. So I'm not 100% sure why we can't just get core system reports that generate this specific information. It's based on the maturity of the repricing date, so it shouldn't be that difficult, but so repricing, there are a few things that might be outside your core reports that get put into this mix. One of them is unplanned overdrafts. Those always get reported at 3 months or less. They're ideally going to be temporary, and technically you have to write them off. So unplanned overdrafts, credit cards always get reported at over 1 year through 3 years. And we've moved away from this, but if we're ever in a situation where your loan is at its contractual floor or ceiling, it gets reported as a fixed rate until it reprices, and then it can float again. Most of your core reports understand this and do this for you. Every once in a while, this M3 loans to finance commercial real estate, construction, land development, not secured by real estate. I'll see this on someone's call report. And a lot of times it'll be like a small bank that does almost no commercial lending. So it's generally just a mistake. So I don't know how people end up putting numbers on here, but this is different than commercial construction. This is commercial construction when you have not, when you don't have the real estate as collateral, you're using some other collateral. And then M4 is ARMs. So if you have any sort of ARM loans, you have to pull those out. I think 041 reports every time, and the 051 reports in June and December. A lot of times I find this either as its own item or when you do your loan maturities, it separates them between fixed and variable, and you can pull it off of there. Mergers. So RCC is RCC M7 is PCI and negative amortization loans from mergers. Purchase credit impaired loans are loans that are acquired from a financial institution that are deteriorated, that may not be repayable. So instead of including them in the pool of loans that move over, they're given a specific impairment amount that carries over to the acquiring bank. They were called PCI loans. I should have changed this. Now they're called purchase deteriorated. And we'll talk about that with the impact of how we deal with these when we get to CECL, because that does impact our CECL reporting as well. But this gets reported forever until those loans are gone. Which I've gotten into discussions. I'm like, we don't want PCI loans because this is a pain for reporting. And when you do a merger, then people lose this. And then 4 years later, well, can you give me documentation for your PCI loans? And they're like, well, I don't know what you're talking about. It's just a number on the balance sheet. And I say, no, they're actual loans. If they get paid off, you have to get rid of them. There's a whole process, and then they get lost in the shuffle. So if you do have PCI loans, save the documentation because you're going to need it for a long time. M8 is closed-end loans with negative amortization features. Those are pretty rare. 9 is in the process of foreclosure. This is depending on your local rules. If I recall correctly, Michigan has kind of peculiar foreclosure rules. Where you own the property, but you can't take possession of it. So there's a period where you actually foreclosed on it, but you don't actually have it. There's some weird stuff that go on in Michigan. Whatever your specific rules are, if you're in the process of this foreclosure, it goes on here. The distinction would be like the difference between in the process of foreclosure and ORI, like when it's over. M12 is only done semi-annually if you have a merger. So if you acquire loans through a merger, you have to report that June and December, and it's only for the year of the merger. So ideally, you want to do a merger. The best time to do a merger, in my opinion, is October 1st. Do you want to hear why? October 1st is the best time because you have an entire quarter to figure out all the accounting and get that straightened out before you have to file the call report. And you only have to do any of the merger related accounting on one call report. And then you start over the next year. I think the worst time is like February 2nd. Like you do not want to do a merger at the beginning of February. Now you guys probably don't have a whole lot to say in that, but if you want to keep your fingers crossed, and that's when you want to do it. All right, interest reserve loans, again, pretty rare. Pledge loans, These are general FHLB, but you can also pledge loans to the Federal Reserve. It's not as common. These from the FHLB come off of your QCR, which is your qualified collateral reporting from FHLB. This is a kind of weird thing. You have to do the call report to be able to do the QCR, and you need the QCR to be able to do item 14 on the call report. So you kind of got to toggle between them. You should be reporting the current quarter, not the previous quarter. So that means you actually have to do this before you file the call report. But again, it's a little tricky. You need the call report information. And then does anyone here do reverse mortgages? I have one bank who does reverse mortgages. It's only reporting in December. And then back to this M16, these are any of those HELOCs that were converted to non-revolving, if we have those. This one, we probably shouldn't be reporting anything anymore. I'm just leaving it up here because it's still on the call report. These are the section 4013 modifications for COVID. This is long done and over with. There probably shouldn't be anything on here anymore. Although it is unclear when the national, because it says December 31st or when the national emergency has ended, but I don't know if anyone has specifically said it's ended or like how that, like I've never had a national emergency since I've been alive. So I don't know what the protocol is for them telling us that it's officially over. But I would probably not expect to see any of these COVID mods on here. What some banks are doing is they're just leaving all the ones they did. And the intent was just the ones that are active. So like when you originally did them, you had to report everything that was, but some banks are just leaving them on there from the beginning and just carrying them through. If you have them on there, take a look. It's probably time to take them off. This is one of those areas on the 051 form. You only have to do this June and December. This is the loans to small businesses and small farms. Most of your core systems create reports for this. So you don't have to do it manually. If you do have to do it manually, which some do, you have to sort it by the original amount, but report the actual balance currently, net of any participations. Questions? Where are we at? Oh, I think we're gonna get through exactly where I want to mostly be. TDRs. This usually takes a lot of time to go through TDRs because it's painful and it's TDRs. But one of the very, very happy things that has come along with CECL is that TDRs are going to for banks. This is going to create more headaches for you in the form of disclosures if you have to do disclosures on TDRs. But for the call report, effective with the adoption of CECL, there are no longer TDRs. We are no longer reporting TDRs. So what I believe should happen is when you adopt CECL, when you go into your call report software, March 31st call report, and you click that button, that little box that says we've adopted CECL that's been there for like the last 6 years, it's going to gray out the TDR section of RCC and RCN. The call report instructions, the main instructions have not been updated, but the supplementary instructions have been. So my thought is we're going to get updated instructions probably like April 25th. You guys know what I'm talking about, right? Like, are you kidding me? You're going to put instructions for the call report due on the 30th out on the 25th? What are you doing? But yeah, so I'm expecting that's going to be, and we've known this has been coming for like this. Okay, I'll give them a little credit. The TDR rulings came last year. Those were kind of an afterthought when they realized, okay, we're no longer useful. We're just going to make it go away. So that's not been out there for 6 years, but it's been out there long enough. So I expect the instructions to change. but it is in the supplementary instructions currently, and it has been for the last few quarters. For any of the banks that have already adopted. So all those slides that are related to TDRs just went away, which is kind of great. I'm curious how that's going to play out in real life, but we'll see. Oh, I guess I did fancy stuff on this one. Okay. And then I like to do RCN at the same time. RCN is, it's pretty straightforward. You are reporting any past dues, non-accruals, or any loans that are 90 days or more past due and still accruing based on the call report code. Most of the core reports have reporting for this. I do want to focus on this. So we're reporting 30 days. So not 31 days, it's 30 days. So anything that's 30 days to 89 days gets reported in the first column. Anything 90 days or more and still accruing gets reported in the second column. And anything that's on non-accrual gets reported in the third column. 90 days or more and still accruing. As an auditor, when I put my auditor hat on, if I see anything in the middle column, 90 days or more past due and still accruing, that's a huge red flag to me. And it's a red flag because I need to now ask you specifically, like generally I don't do it for residential real estate, and consumers they're not very big and I'm not concerned about those, and the rules are a little different. But if you have any sort of commercial loans that are 90 days past due and still accruing, I'm going to ask you for documentation that the loan is both well secured in the process of collection. So well secured is usually not a problem. Most of the time there's collateral sufficient, but the process of collection is really where people kind of take some liberties. So a lot of times, well, we called them and they said they were going to pay. That is not the process of collection. The process of collection means we're expecting a payment to be received within 30 days as a loose guideline. There are some situations that make perfect sense. For example, the loans on non-accrual, but there's a closing to sell it the following week, and we're going to get a check to pay off the loan. Good with that. Another scenario would be the loan is paying, but it's considered past due because it hasn't been renewed. It hasn't been rewritten. So technically, any of those loans that are past their maturity by 90 days or more, they can still accrue because you're still getting paid on them. They're not a troubled situation. It's just a matter of it getting renewed. So that would be appropriate. There are good reasons, but they should all be documented. And as the call report preparer, you don't have control over that, but you need to at least be aware of it. And you probably need to ask those questions. The reason this is a red flag for me is if you have loans that are 90 days or more and they're still accruing and they shouldn't be, you've likely overstated your income. And if you have one loan and it's not that big, that's fine, but it tends to be that this happens when whoever was in charge of that somehow stopped doing it and nobody started doing it. And we start to see like, okay, there's definitely something going on. So keep an eye on that. Anyone have Ginnie Mae loans? Okay. So this section number 11 is going to be of the loans that are on non-accrual or past due, which ones have guaranteed portions. So if you have USDA guarantees, if you have SBA guarantees, if you have any of that, those would get reported on 11 and then also on 11A. Additions, memoranda 7 is additions to non-accrual assets during the prior 6 months. This one we have to do this every 3 months, and it was actually a little bit easier. Now we have to keep track of, they made it easier for us, but it's actually harder. Now you have to keep track of 6 months and go back and say any loans that were added. We're not subtracting out the difference between the two. We're actually counting, okay, this loan was added in June, even if it was taken off or paid off or charged off, whatever, because it was added, we're including it in this amount. And to do that, you kind of have to go back to every single non-accrual report and compare them to see what was added. And it's pretty uncommon that you'd be selling non-accrual assets, but it's possible. PCI or PCD loans, these are the same as what we reported on RCC, except for of those loans, these are the ones that are past due or on non-accrual. Questions? Okay, all right, so that's all the loan schedule. Everything you ever wanted to know about call reporting loans. RCK. RCK, I have a love-hate relationship with. I love RCK because I use all of the information that RCK gives me because it's the quarterly averages, and those are super helpful in real life when I talk about ratios and profitability and all those other things. I hate RCK because it's really hard to get good information sometimes. Depending on how your balance sheet is set up, depending on how everything else is set up, it could create some challenges. In addition, on RCK, this is where you get a ton of edits from, because what it's doing is it's comparing your income to your averages. And if you reported something incorrectly or something went weird with your income, it's going to say that the amount that you have in income or in averages doesn't look right. Go figure it out. And maybe you guys are consistent so you don't get these problems, but when I jump in and do a new call report and kind of move things around, it gets a little bit wonky. Total average assets are probably one of the most important numbers on the balance sheet or on the call report, because that helps us calculate our CBLR ratio. And the CBLR ratio, if we opt in, is the leverage ratio. And that means we don't have to complete our CR part 2, which is risk-based asset, if we don't want to. So that's an important number. And as an auditor and even examiners, I would expect them to be looking at that number very closely to make sure it's accurate. I've had all kinds of issues with average assets over the last few years because there are average asset reports on the core system. Most core systems have it. But I still see a lot of banks trying to manually calculate average assets, which is really, really difficult. So if you don't have a report, I guarantee you there is one. Message me, I will help you find it or give you a number of a report, because I know that there is one. If there is not one, because you have a core system I've never heard of, there's a way to create one. And that's what you should do, because the more accurate this information is, the less question about the data integrity, the less chance for manually changing something that shouldn't be, the better off you are. Okay. So what I did with these slides is I tried to align them with the averages align with where they go on other schedules. So for example, interest bearing due from accounts all come from 1B. So whatever general ledgers you reported on 1B get reported on RCK 1. The security section, there's two schools of thought on this, and there's probably a mix in this room on how you do it. Some banks use their balance sheet amounts and they're good with that. Other banks defer to their bond reporting, because you get this with your call report documents. Most of the time they should be pretty close, but the reality is your bond reporting is probably more accurate because that's actually a daily amount, whereas your balance sheet average is going to be you making an entry once a month, 3 times. So it's a static amount for the entire month until it changes, whereas the bond reporting is a true average. I don't think I've ever had anybody criticized about that. Again, the amount should be relatively close, but I do see both schools of thought. Fed fund right off the balance sheet. Loans, it's possible your general ledgers are set up where you can account for these using the general ledgers, but it's possible you may have them all mixed together in some ways. So you have to go back to a core report to tell you what the loan averages are. If you're using a core report, don't forget you have to net out any of those other things like the fair value adjustments or anything like that. And these just are references for you. Total assets. Okay. So total assets, I would say that probably 60% of the banks I work with calculate total assets wrong. Which is kind of crazy because it's one of the most important numbers on the entire call report. So one of the reasons that they get that it gets calculated wrong is because we just go in and take off, we get our average balance sheet and we take total average assets off of the balance sheet. We can't do that, especially if we have available for sale securities, because the available for sale securities have to be reported at amortized cost, which means we have to eliminate out the impact of the unrealized gain or loss. So in order to report the investments at amortized cost, which is included, which is easy to do for the specific investment ones, it's a little trickier for total assets because the unrealized gain or loss is included in the total. We have to back it out. We also have to apply any methodology used when we completed RC. So if we had to move the deferred taxes from liabilities to assets or vice versa, we have to account for the impact of that, which could be pretty significant right now. Yes. I would look at the averages though. So yeah, so that's a good question. Like if it was 1 month out of the quarter, I wouldn't be so concerned in that situation. But if the quarterly average was negative, then I would do it. But the deferred tax is always going to have to get moved. The other thing that is important, if you have, does anyone have like subsidiary banks or like elimination accounts? If you have elimination accounts, you should be looking at those accounts to make sure that they really belong in your total on the balance sheet. Okay, so you're good. Okay, yeah, I do have one bank that does eliminations on their subsidiaries where they have like intercompany accounts, and those intercompany accounts at the end of the quarter all clear to zero. So we need to eliminate the average, the impact of the averages because it's not real. So like just watch for things like that. Really, you should be looking at RCK the same way you look at RC for the most part. All right, interest-bearing transactions accounts, same thing. The time over 250 and under 250, hopefully you have a report that can tell you this information because it's hard to figure out otherwise. I think it usually comes, there's like application reports that you can pull to get this information. Otherwise, you might be able to use general ledger balances to approximate. And then Fed funds purchased and other borrowed money. If you're over, pretty much everyone has to do that. Okay, questions on RCK? RCL, that's the off balance sheet items. So full disclosure, anyone using the 041, this is the 051 version. The 041 version is a lot bigger and has a lot more details related to derivative type activities. So if you have secondary market lending, do you guys do that stuff?
We have secondary market. We've also, one of my questions has been inquiring about, we recently started leveraging the interest rate hedge. We would do the rate lock with the customer.
Yeah.
And we would immediately take out a contract for that.
Yeah.
Now, instead of doing that, we are going to market and hedging it differently, which I totally don't have my head wrapped around that. We just started doing it fourth quarter last year.
We
So
might,
I'm not 100% certain everything is accounted for correctly in our fourth quarter.
In fourth quarter. Yeah, we can, maybe I will give you one of my cards to talk more. I do have a few banks that are doing the like when you start, RCL can be really simple if you are not doing secondary market lending. If you're doing a lot of secondary market lending with mandatory lock contracts, then it gets really complicated really fast. So RCL on the 041 form is pretty much your unused commitments and your letters of credit. On the 051 form, that expands out to anything that's off balance sheet, which is generally any sort of derivatives or activities related to the fair market or the valuations and hedging and all the other stuff. For most of us, ideally, it's better if we can get a report that includes the maturities when we get this information, if we're doing RCR part 2, because then we can kill 2 birds with 1 stone. This also includes things that might not be on your loan application. So most of the time there's a report that tells you what the unused commitments are by call code, but like your credit card unused commitments aren't going to be on there. And you might have like a separate report or module for like ready reserve, any sort of unused commitment related to the overdraft protection lines, things like that. This should also include any loan commitments that have been booked to that have not been booked to the system. So if you do a loan commitment, and not all banks keep track of this, we tend to more with the 1 to 4 families, but this technically should include any of these loans in your pipeline. But I will be honest, not all banks do that. And again, I don't see a lot of pushback on it until there is, but in theory, if you're doing like commitment letters to your customer saying you have loan commitments with them, they should be reported here as well. This is a tough schedule, and it's, even though it's like 10 lines, it's tough because the numbering is really confusing. This is kind of my guide. Every time I look at this, I literally pull this out and I look at it because they don't line up. So on RCL, 1A is actually the unused commitments that are associated with 1C1. And that's all good, but like 1B is different. So on RC, we separate commercial and consumer credit cards. On RCL, we combine them. Unused commitments. 1C1 is any 1 to 4 family construction. 1C1B, this is the one that's usually I see wrong. 1C1B is any sort of commercial real estate that includes commercial construction, multifamily, owner and non-owner occupied. And my favorite one that causes the most confusion is 1E1 on RCL is commercial and industrial loans. So it's not 1E1 on RCC, it's number 4 on RCC. So this is just unnecessarily confusing. And then everything else goes in 1E3. So I kind of use this as my guide. Generally, I'll be honest, I try not to look at RCL, but most of the time it's not a big deal. RCL isn't that, there's not a lot going on, but if I need to, I will. And it's usually wrong because this is super confusing and reading the instructions makes it more confusing. So this is a very handy tool. Letters of credit, there's 3 different versions of letters of credit. There's standby, financial, and performance. Most of the there's standby and commercial, and of the standby, there's financial and performance. It's pretty, does anyone have commercial letters of credit? Those are pretty uncommon. Those are usually used for like international trade. I don't see them very often. I don't know if I've ever seen them. If I did, they were not reported correctly. What you're normally going to see if you have them is financial or performance. More often we see performance because those are ones where somebody's doing a job and they want it protected with a letter of credit. So as long as they do the job, everything's good. If they don't do the job, then the letter of credit gets advanced. The other one I sometimes see would be like a financial standby, which is most of the time I'll see them with gas stations where, I don't know, sometimes gas stations just go belly up and don't pay their fuel supplier, and there could be like hundreds of thousands of dollars in fuel costs. So they require whoever the gas station is to take out a letter of credit. So if they don't pay them, they can advance the letter of credit. Those are the most common ones. Anyone have an FHLB letter of credit? So, this is kind of like the circle of what's going, this was happening before 2020. And you know, this one kind of got sidelined, but we back to make this conversation. Banks need deposits, and one of the larger sources of deposits are municipalities, municipal funds or commercial funds. And in a lot of cases, they exceed insurance limits. So the depositors want to make sure their funds are protected. So historically, banks either need to do like repurchases, CRs, ICS, or have municipal agreements of some kind where they pledge securities. Problem is that starts to impact their liquidity because they're pledging securities. So what some banks do is go to FHLB and get a letter of credit, which they use to essentially collateralize those deposits and allow them to take in more money and be able to then in turn lend out more money. So those are becoming more and more common. A lot of banks don't really know they're out there as an option, but they are a good option if you're looking to do that. There's other options too, but that's one of them. Oh, I did put these in here. But this is probably more of an offline conversation on where the hedges go. I just actually like 2 days ago looked at hedge accounting for another bank, and it takes a minute. And like 3 other accountants. We'll talk more. Okay. RCM is the memoranda schedule, and this should bring us just about to lunch. RCM is kind of the catch-all for everything else. We don't fill out everything on here, but we'll talk over the schedules we do. The first one is extensions of credit to executives, directors, principals, and related interests. This is what I call a low-hanging fruit. Almost every time I look at a call report, I check this. This is Reg O, and it should tie out, because the problem is if this is not right, it could cause you some issues because it is Reg O. So understanding what this looks like is important. The first step is making sure you have everybody. Are you including all of the executive officers, all of the directors, and any shareholders with 10% or more, and their related interests? So the related interests tend to be the tricky part, making sure you have all of those documented. Are there procedures in place if a new executive officer is hired, if a new director comes on board, if there's shifts in the shareholder situation? Those are all important to figure out. I had one bank, I set their call report up for them in like 2016, and she never updated any of this information, and they got new directors and new employees, and then they had an exam and it was wrong. She was still doing exactly what she did in 2016, but she never added the new people that had come in since then. So just making sure there's a process. You do it once a year, a couple times a year. It's the extension of credit, not the actual outstanding balance. So that is going to include any sort, if it's a business, it could be any sort of extension that they have to cover ACH or anything like that as well. There are some exclusions. Most banks just include them because it's easier and less messy, but you can exclude credit cards under 15,000 and overdraft under 5,000. There are some other exemptions for like first homes through Reg O, but that gets way too dangerously close to compliance for me to talk about. So, I've only had, of all the banks I've ever worked with, I've only had one bank actually do a lot of the exemptions under Reg O and not report them. Most banks are just like, whatever is on the system. It's easy to report. Mortgage servicing assets. Okay. So mortgage servicing asset is the carrying value of the loans that you are servicing for investors. This generally comes through a process. Either you do it internally or you hire it out. You have two choices. You can use the fair value method or the amortized cost method. However you're calculating them, you've probably been doing it for a long time. If you use the fair value method, what you report on 2A and 2A1 are going to be the same. If you use the amortized cost, those numbers are going to be different. This is at least 2A is going to be on your balance sheet. The fair value, if you use the amortized cost, would come from whatever your calculation is. The other intangibles are goodwill and then other identifiable intangible assets. Generally, these are going to be core deposit intangibles. Are you guys selling SBA loans? No one's selling SBA loan. That was a fun thing to start doing last year. If you do start selling SBA loans, if you plan to account for it appropriately, there should be a servicing asset for your SBA loan. The SBA loans that are secured with mortgage collateral are considered a mortgage servicing asset. SBA loans that are not secured by real estate are considered an other intangible asset. So if you do go down that road. Other real estate owned, we talked about this earlier a little bit. These are carried at the fair value less the estimated cost to sell. This is where we get to GAAP again. The amount that rolls up to 3A through 3G is based on GAAP, which means that what's in your general ledger has to be calculated this way and you should have support for it. If you have a property that the bank purchased or intended to be used for future expansion, and then you decide you're not going to do that, then it becomes ORE as well. Number 5 is other borrowed money, 2 categories, FHLB. Most of the other borrowed money is going to be from FHLB. That comes right off of their e-banking. And then other borrowed money could be from the Federal Reserve, those due from balances that are negative. There's other random weird things that could go here too, but normally I don't see much going on there. And all of these are reported based on their maturity. Oh, that's not applicable anymore. We don't care about PPP loans anymore. Does anyone have any left? Couple, like 1 or 2. Yeah, I'm starting to see them just completely gone now. All right. Okay, that brings us to lunch. Look at that. We have 7 extra minutes. So it looks like our lunch is over there in those bags. We can go grab it and start eating. And then we'll probably plan on jumping back around noon. So we'll get a little extra lunch time as I talk fast and you guys don't ask a lot of
I thought you were joking.
Well, oh my God. Something that, you know. Very intriguing. Cool. I was having that for Dustin. People asking for my family recipe. Somebody wanted them. Or don't the way that you really want to keep. I can get details and just. Also. Yeah.
There's. Later.
Like. mean, I feel like that was there. Like I can put it on my check. Because Gail texted me a picture. We're gonna like, that was our plan that evening. Kind of been like we've been looking like. My God. But, like we're seeing. Thank you. I would just not. Like everything. He never. Even though I have like 3 other projects. No. I just need to go buy it, I think, right? Yeah. They make one. where they go on. But now, they don't go where they're going. Now they're coming to- Judging you. Yeah. I would not like work with my cat. I learned crafting house and like. And when I was there, I wanted to go. I'm like, it's not brothers. It's okay. Do they like? I'm like, no. I don't.
My staff, all staff, you know. My chat's real. Well, look at how fun the car, give you how.
That become a lot more.
Right. I grew up in-
Very.
It seems like that's what you see from the-
Maybe you have it.
That was my dad, that was no problem. Big portion of it was like a large dollar,
Yeah.
and so yeah, we don't see that at all. For now, I mean, it might change.
You just say that.
And- But then you're spending. It's like, Wow, when I'm about. Oh. We can- I like it mine though.
I think you have, what I think you know, what am I like?
We'll be there. Right. The seller. Go to here.
Thank you. Now I have to go to the dentist.
I know, and that's. Me neither, but yesterday at home, so I'll use my remote section tomorrow. Go get my- Next question is.
We just, I guess like I thought part of the reason was. Other. I thought we were fine. But it's because, like, we get total overhead. We were- It's not also like total overhead. Future, I need to figure out this. Oh, time, it's funny, like. Yeah. She's like, these are getting encompassed, like, these are getting my show for January. This is all done, this is all set up. You just confirm. I'm like, yep. I saw that one and I find that in my.
like, I just can't remember, it's like Sarah.
Then they forgot.
And I know I'm like, like, I haven't.
There's a couple like back in Norwich.
Are you here today? Almost responded to that, but I didn't. Well, I almost, I literally had like my. I was like, no, that can come off. We're gonna be like. And. Like we had these.
Appreciate that.
Yeah, the steps are done. We just don't. That's a. So frustrating. I went through like every folder to see if I see it all. Like, your job gets on me. That's what I'm thinking. Yeah, it was a board decision and it just like came down on.
Okay. You guys put out fires from here.
Just looking at the fires.
My strategy is not work because I'm like, I can't focus on this. I do, I mean, to be fair. I don't need them to make something that is.
Different
Like, yeah, and this is hard, like I have to think how I'm doing that, so it's like hard to be distracted. I can't think about like other things, so I'm like, I'm just not. I have actually, most of my people are in the same time zone, so. After we're done, still. We can do more. Doesn't help yesterday. It was in O'Hare Airport. I think I had like 3 hours of meetings sitting in O'Hare Airport, which is not necessarily conducive to thinking. tomorrow I'll be able to, my flights are. Although the ones yeah. Is actually, it's a lot like the one I came from in CW. Okay, I think we're all, we're almost all here. I don't know if. Okay, it is 12 o'clock exactly, so we are on to part 2, the home stretch. So this afternoon, I want to cover regulatory capital. I want to talk about the other schedules. We'll talk about the income statement and CECL. And then if we have time, we'll do any other topics related to the call report, anything that's interesting to you guys. Regulatory capital used to be super complicated when we all had to do risk-based capital. Now with the CBLR, we're able to kind of simplify that. So we're going to let's start with challenges. Do you guys have any specific RCR challenges that we want to talk about? Questions, things we want to know more about? All right, we'll go through it. I can kind of touch on that. How many of you guys do the CBLR? You guys do. And the rest of you are still doing risk-based? Okay. It's always a good idea to remember the risk-based because you never know when you end up back there. So we don't want to completely forget that, even though it's kind of a lot. I try to do it in a way that it's more thinking it through than just this number goes here, because when you start to do that is when you get in trouble. Like really understanding what it's asking you is the key to having that part go smoothly. Okay, so in 2015, the way we did call reports changed with Basel III. And my understanding is they're talking about this again, and we may see changes in the future, but right now, this is the world we live in. So one of the things we learned in like the 2005 to 2013 range when all the banks were closing is our understanding of capital wasn't really accurate. When we calculate capital before, we weren't really considering a lot of the pieces that we needed to be considering. And one of those things was the intangible assets. So we were including goodwill, deferred tax assets, MSAs, other things into there that really probably was doing what our capital ratios really look like. So if my bank had a huge mortgage servicing asset and your bank didn't, and everything else was equal, we would look the same, but really your intangible asset had a different impact on your capital than my bank did without that. So we created a new calculation that said, we're not going to be able to include all of the assets in capital. We're going to have to exclude some of them. Some of them are going to be completely eliminated. Others will let you include a certain amount. And then after that, the rest needs to be eliminated. Other things like investments in financial institutions had to be addressed as well. One of the issues that came up back then was banks were very interconnected. So the equity of one bank was connected to the equity of another bank through the purchase of stock or other instruments like sub-debt or trust preferreds. And when that happened, if one bank had issues, it had a domino effect.
So we added that to the calculation so we could see how banks were interconnected. So RCR part one, for the most part, is pretty straightforward. I would say, I don't know, 80% of the banks that I work with, if you go to your software and press the button to import the information into RCR, it's going to input it correctly and you don't have to do anything else. There are some scenarios that require additional understanding. So that's what we're going to go through, because otherwise this RCR part one would be 12 lines and we'd be done with it. But it's not, it's more. So we'll go through the other items. We're not going to spend a lot of time on the areas that don't really matter to us, but this is the top part. This is lines 1 through 5. This is what looks just like your balance sheet. Now, this here is going to be new, and we'll talk about this when we get to CECL. It's the CECL phase in provision, so that's a little different. That's gonna make this a little bit different. But this is gonna come directly from the RC schedule. This shouldn't be a problem. And for most banks, this is the majority of what you're gonna have to fill in here. Then we get to the next items, and these are the items that get subtracted out of equity. And if you had a merger, it's likely you have goodwill or intangible assets. The goodwill stays there pretty much forever, unless it's impaired or you can start to write it off. And the intangible assets could get evaluated and written off at some point as well. These are both net of any associated deferred tax liability. Now, that doesn't mean net of the deferred tax liability. It means net of any deferred tax liability that's directly associated with the goodwill or the core deposit intangibles. Line item 8 is if you have a deferred tax asset and you have an NOL carry forward, net of the DTL, that full amount gets deducted as well. Those, I see them every once in a while, but they're not huge amounts anymore. They're relatively small. That could change as time goes on. Number 9, item 9, everybody, if you have selected to opt out of including AOCI, which almost every bank, I've not run into one bank who includes AOCI. And it gets back out in number 9. So what that does is it essentially makes your capital, your regulatory capital, like we talked about before, is your balance sheet capital, subtract out intangibles, add back the AOCI. And that's how we get to line 12. This one is pretty uncommon. I don't think anybody would have this. I've run across one bank that they're in Wisconsin, and the state of Wisconsin allowed them to create a subsidiary for a redevelopment project in the community, but it's not bank related. So even though it's a bank subsidiary, it can't be included in their capital. Very rare. Item 13, this was one of the changes that came in 2020 with the CBLR. This is investments in the capital of an unconsolidated financial institution. And this is a threshold deduction. So I can't imagine that any bank here would go over this amount. This would be if you have stock or like sub debt or trust preferreds. It's tier 1 capital here. So this is really mostly just if you own a lot of bank stock in another financial institution. The other threshold-based deduction that could impact everybody here is the MSA, the mortgage servicing asset. And the way we figure this out is you have to take line 12, which is that initial equity amount, multiply it by 25%. Whatever is over 25% gets reported here. The first 25% is not reportable. So majority of the banks that I work with don't exceed that threshold. In order to exceed that threshold, you primarily have to be a mortgage bank that just originates and sells mortgages. Otherwise, you're going to be within it, unless you have really small capital. I guess that could be another reason, but most of the I rarely see this exceed the threshold. One of the other changes that got missed, though, is if you have mortgage servicing rights and you use risk-based assets, you have to now risk weight that includable amount of mortgage servicing assets at 250%. Historically, it was at 100%. And this could have it could have an impact on quite a few banks. I think the software has figured this out and now there's edits. There wasn't for a while. This one is the DTA from NOL carrybacks. I don't think I see this one very often. It's pretty rare. And then this one is pretty rare too. You guys, Wisconsin loved trust preferred stocks. We had a few banks in Wisconsin, Park Bank, Johnson Bank, there was a handful of them that all issued trust preferred stocks back in like the 90s and the early 2000s, and the local banks just gobbled them up and they caused all kinds of problems. And a lot of banks are still sitting on them because there's no market for them. There's nowhere to go for them. But those are the trust preferred trust, and they could potentially have to be deducted out of cap. And then we just pull down the totals and we get to item number 26, which is our tier 1 capital or CET1 capital. And that's the amount that we use to calculate all of the capital ratios, at least the CBLR and the tier 1. So that's not going to change whether we use risk-based or whether we use the CBLR. Line number 27 is our average total consolidated assets. This is what we just talked about on RCK, and this is why this is important. And then we're able to, this is the tricky part. So in RCK, in our total average assets, it includes all of our intangibles. For the purpose of calculating capital, anything we've already taken out of equity, we're not going to also leave in our assets, because then we're going to have like doubling the impact of that. So when we deduct the goodwill, when we deduct the core deposit intangible, when we deduct MSR, we're also going to subtract those out of our assets as well. So we're not double counting them. And that happens in line 28. And then that line 20, I guess I did item 28 twice. So this must be item 29. Item 29, we did use this. I think it's there just in case. The reason we use this one, other deductions from assets for leverage ratio purposes, when we did the PPP loans, when we pledged the PPP loans against the FHLB line of credit, if we use that, we were able to deduct that here. I don't know of any other purpose for this line, but I think they just put it there in case anything comes up like that. And then the total assets for the leverage ratio. And then it's to the point where we have to decide, are we going to opt in or opt out of the CBLR? So the CBLR, there's two ways to calculate capital for financial institutions. The first way is the community bank leverage ratio, which is new as of 2020. And it really is just the old leverage ratio back in the day when we used to calculate the leverage ratio. That's what's a couple little tweaks to it, but essentially it's the leverage ratio. The other way is using risk-based assets, and that is RCR Part 2. And that gives us a set of
capital ratios, the important one is CET1 or Tier 1 capital ratio. And those are the two options for determining if the bank is well capitalized. And the reason it's important to do that is if it's not well capitalized, it also tells the regulators when to start enforcement actions and corrective actions. So these are really important ratios. So if there's anything that rolls up to these ratios that's not correct on the call report, that's going to be where there's going to be biggest issues, the materiality, like the average assets is going to impact a number that's really important. How many 1 to 4 family loans we have could potentially impact a number that's really important. So, so now once we know there's risk-based and there's a CBLR, we kind of have to make the decision, which way are we going to go? And I already asked you guys this question, so we'll skip that. If we decide to go with the CBLR, we want to make sure that we are one eligible. And the primary eligibility is you need to have a 9% capital ratio. Now, if your CBLR ratio, if your leverage ratio is below 9%, that's not necessarily a bad thing. That could be just strategic based on the way your bank is set up. You can still do the risk-based capital. I find that there's quite a few banks that have maybe a leverage ratio of a little over 8, but then they have like a risk-based capital ratio of 14, which is very high. And it's how the bank is structured and how they choose to lend money, how they choose to invest money, if they've had recent mergers, things of that nature. So the CBLR isn't necessarily right or wrong. It's just an option. You can, if you elect to use the CBLR, you can drop below 9% for 2 quarters. You have a grace period to be able to get back up. So if you end up at like 8.9 for 1 quarter and then the following quarter, you're back up to 9%, you don't have to go back to risk-based. You can kind of wait it out and see if you can get it to go back up. There's other eligibility criteria, which we'll talk about. I don't think any community bank is going to have an issue with meeting that. And you can choose to opt in and out of the CBLR any call report. So unlike a lot of elections, you have to like pick your lane and stay in it. The CBLR, you could go crazy. You could just do every other month. You could do every 3rd month. I don't know why you'd want to do that, but you could if you chose to. So if you do opt in, you have to fill out the leverage ratio. This has to be 9% or within the grace period. And then you have to select 1 here. If you select 1 here, this is going to black out all of our part 1, the second half of that, as well as risk-based capital. It'll just be all grayed out. You can't put anything in there. So what is better? Well, I don't know that there's a better or worse. I can say CBLR is definitely easier. There are reasons you might want to go that direction. There are reasons that banks like to retain the risk-based capital because they get more information potentially. But this is kind of the rule of thumb. The leverage ratio, if you're using the CBLR, needs to be 9%. If you're using risk-based capital, you only need to have the leverage ratio at 5% as long as your Tier 1 is at 6.5, which is really quite low. So there's some flexibility here. Now, what the argument was that if you choose the CBLR, you're forcing the bank to keep more equity than they need to. Like your requirement for capital is higher than if you use risk-based. Why would that be a concern? You might be looking to do a merger and you wouldn't be able to keep the 9% if you were doing a merger, but you would be able to meet these ratios in the capital buffer. So it really comes down to like, what is the bank's strategic direction? Which of these calculations makes the most sense? I see probably 50-50.
I see quite a few banks still voluntarily using risk-based capital. And I see quite a bit, and I would say there's certain applications. There's a bank that, it's a small community bank. They're not super complicated. They have a CBLR ratio of like 15%. They don't have a really large staff. Yeah, it probably makes more sense to do the CBLR. I have another bank where, they want to use the risk-based capital because it is more, they can see exactly what everything looks like. They can see what the loan risk looks like. They can see what the investment risk looks like. They can get a good understanding of what exactly is going on. And that's more beneficial to them. I thought I took that out, but this was kind of an example. These have all expired now, but you were able to use the grace period through COVID. It's, I guess, a good example of the grace period as well, like when you would need to have the CBLR versus go back to the RCR Part 2. This is the second half of RCR Part 1. If you choose to opt out of the CBLR, you do have to complete this part of Part 1. And what this is, oh, no, hold on. This is the CBLR qualifying check. The qualifying, and most of them are, if you have trading assets, those go here. That could affect you. But the main thing that's going to impact normal banks is your off-balance sheet exposure. And this all comes from a couple different places. The unused portions of the commitments comes from RCL. That's that number one, all those unused commitments based on the categories. It also includes securities bought or lent. So anything in 6A or 6B on RCL. If you have a lot of secondary market loans, you might have warranties or recourse on it. Usually this only happens if you sell to yeah, it's usually if you're selling to investors that aren't like typical, like Fannie or Freddie or FHLB. There's unique features in those, and you have to report those here because they're kind of they're a off-balance sheet liability. Credit enhancements, if you have an FHLB program, that needs to get included here if you have one of the original programs or any of the programs with the credit enhancements. Standby letters of credit and some forward commitments that are not derivatives, which are not real common. So as long as these are under this 25% threshold, 25% of total assets in total, you're good to use the CBLR. Grace period does not apply. You are not eligible. Now, before you switch over, there's something that you probably want to consider. This has become a hot topic with CECL. There's two types of off-balance sheet commitments. You can see here, this one says conditionally cancelable, and this one says unconditionally cancelable. That's a big difference because anything that's considered unconditionally cancelable does not need to be included in the threshold amount calculation. The unconditionally cancelable are any sort of loans where you can pull the line of credit anytime for any reason. Credit cards are almost 100% unconditionally cancelable. That's like if you have your Amazon card, and I'm picking on Amazon, I don't know if this is true or not, but like you pay your bill every quarter and you just get Amazon points, and then they're like, we're not making any money on their finance charge. We can just pull their line and say they're done. Same idea. Generally, we see them also with
home equity loans, a lot of times those will have wording in the loan contract on the note that says that they can cancel the line at any time for any reason. There could be some built into commercial. I would not recommend, if you don't have to, trying to figure this out on a loan by loan basis. But generally, if you're using the same note for all of your home equity loans, you can make the assumption that all of those are unconditionally cancelable. That's where I would go first. You're starting to tip up that number. That's the first place I would look. Additionally, out of the like if you're putting on RCL those commitments that have loans that have been committed but not booked yet, those could also be considered unconditionally cancelable because you haven't actually done the loan. You don't have a legal obligation to do the loan. You could say, no, we're just not going to, I know we told you we committed to this loan, but we didn't sign any paperwork yet. We're not going to do the loan. So that's the first place I would look if you need to trim that number down. Okay. The rest of these on the bottom aren't really relevant. We did this, advantages and disadvantages. It's so much faster to do the CBLR, like minutes, actually probably less than 5 minutes to do the CBLR and quite a bit longer to do the RCR part 2. I will also say that of all the areas on the call report that I find issues, it's generally in RCR part 2. The risk-based assets are one of the hardest parts of the call report. They take up the most time, the most energy. They're just difficult in general. Disadvantages. The argument is the CBLR requires the bank to hold more capital than if they used risk-based capital. That might not always be the case, but generally speaking, you need to keep 9% as opposed to the regulatory amount, which is 5% if you use the risk-based. And then if you start using the CBLR, it's possible you could lose the knowledge to prepare RCR part 2. After it's been a couple of years, you're probably, if you had to go back, you probably have to brush up. Other considerations, we talked about this, making sure that average assets are calculated correctly. And then just understanding what the bank's strategic plan is. As the preparer of the call report, I don't know that you're the one that necessarily should be making that decision. That should come from like whoever is in charge of the overall strategy and understanding, because there are a lot of times in strategic planning, capital ratios are included in the key performance metrics. So if the bank is using risk-based capital as their performance metric and we stop doing that, there's not going to be someone there. We have to put in some indicators that we can use, like the CBLR, the leverage ratio. So what a lot of banks have done is they have both risk-based and leverage targets. Questions on that? Okay, so part 2 is only if we're doing RCR. Items 39 down are only if we're using part 2. And the main thing we're going to do in this section is add back the allowance. So we're allowed to add back up to 1.25% of our risk-based assets to our capital ratio for total capital purposes. This is, we're going to have a further discussion on this because this amount is going to look a little different. Right now, prior to CECL, it always excluded the allowance, the ALLL plus the unused reserve that could get added back, but there's some other things that are going to get put in there and some things we now have to take out. So stay tuned. And then this is just going to filter down to the tier 1 total capital, CET1, tier 1 capital, total capital, and capital buffer. And as long as those are above, as long as this number here is above 6.5%, life is good. I mean, I probably want it higher than 6.5%. That's like the very lowest, you don't, you probably, if you start getting around 8%, you're probably gonna wanna look at some options of strategies to get that higher. Okay, so that's RCR part 1. Part 2 is, again, probably the hardest part of the call report. In the 041 form, it's completed every single quarter if you opt out of the CBLR. On the 051 form, I don't know why this was done. Sometimes I wonder, like, they do things that are supposed to save us time, but items 1 through 25, which is essentially where we risk weight the assets, is not required to be filled in March and September, only June and December. However, you still need to calculate risk-based assets because we still need that number to be able to do our calculations. So we still have to pretty much go through and do 121 through 25. We just don't have to put it on the schedules. Which if you have a March or a September call report that's being audited or included in the exam, it's going to make it harder for you because now you have to provide all of your manual calculations on how you got to that number instead of it just being on the call report. So I don't understand why they did that one. I don't know how much time it actually saves. But all right, either way, we have to calculate risk-weighted asset. This is not required if you select the CBLR. Okay, so I wanted to do just a high level. This is how the bucketing works. Most of the banks are going to have assets risk weighted into 0 to 250%. So the way it works is if you had whatever your starting number was $7,000, say, and then there was an amount that was excluded, and there are excludable amounts. So anything that we didn't include in equity, be backed out of equity, we're also going to back out here. So we have apples to apples. So our AOCI, our unrealized gain or losses, is going to get backed out here. Any of that goodwill, core deposit intangibles, anything that we took out in part 1, we're also going to take out in part 2, and that's going to go in column B, and we'll specifically look at those. Certain assets have 0 risk. Cash, anything at the Federal Reserve, 0 risk. Some assets are risked at 20%. Some are risked at 50%. Most are at 100%. There's some that are more risky, so they're 150%. And then we have the mortgage servicing rights at 250%. And the way that works out is all of those just get multiplied by that amount. So we end up seeing how much it actually gets, the impact is. So out of our $7,000, if we line just $1,000 across the top, the total risk base would be 57. So because that risk-based asset number is smaller, we're going to have a higher ratio than we would with the leverage ratio. So that's why these numbers are normally, anytime we get any sort of risk-based capital ratios, they're going to be higher than our leverage ratio. Okay. So what I did here, and this has evolved over many, many years, trying to figure out the easiest way to communicate what gets risked where. This has been my current iteration of this, and I think I like it. And I mean, I'm open to suggestions on how this is more easily understood, but it's a hot mess to start with. So what I did for each line item, I went in and put what goes in each bucket. So for cash, this is the total of our C1A and 1B. The fair value, the fair market value is going to put in column 0 because that's part of our unrealized gain or loss, the AOCI. So that's going to get excluded.
anything at the Fed, anything that's cat, anything that's insured gets put at 0. And then everything else goes at 20%. So FHLB, I don't know why FHLB is 20%. It's like the stepchild of the government. Like the Federal Reserve gets to be at 0%, but the FHLB isn't quite as special. So they get 20%. They're government agency. They're just not the government. So they're at 20%. Items in transit and then uninsured portions. RCR are the securities, 2A and 2B held to maturity and available for sale. This information should come from your bond report. Some banks are using just like their general ledger balances to fill these, and that's probably okay. It's not the best way to do it, but when you get to the municipals, you're going to be risk weighting likely incorrectly, because the risk weight for a general obligation security is 20% and a revenue security is 50%. So you'd have to manually pull those out, and it's really hard. But if you go to your bond report, there is usually a schedule called RCR regulatory capital, or there's a schedule that's called risk workbook or risk worksheet. I think the InTrader report from like BOK, BMO, those places has a risk worksheet. But it essentially does this. It groups all of your securities into the buckets, and the buckets are like, this is 0% bucket, this is 20%. And depending on whether it's available for sale or held to maturity, these are all AFS, you would take the book value. And when we get to it, when you get to line E, which is other assets, the accruals, you can also list the accruals in the same buckets. So for this one, the accrual on the 0% is 127. Now, the other thing that we want to keep in mind is on this workbook, you can see there's things here. The top one is certificates of deposit. Just for whatever reason, I've seen some reports include them at 0%. Other reports include them at 20%. You just have to back those out because those get reported in cash. Any questions on this? This is the best way to go because it's a good chance you're not going to understand the risk of these individual securities as well as whoever does your bond accounting. Hedge funds sold are always at 20%. I don't think I made a fancy slide for that. So loans are broken into 2 groups, held for sale and held for investment. Held for sale should equal 4A on RC. And generally, and it could be possible that these could be past due, but normally you don't keep them for 90 days. So in most cases, if they're 1 to 4 family, you can report them at 50%. Okay. So number 5, I like charts for whatever reason. So number 5 is all the loans held for investment. This is kind of the tree. Residential 5A is residential mortgage exposures. These items from RC go into the residential mortgage exposures. So HELOC, closed-ended first, closed-ended juniors, and qualifying multifamily all go into 5A, and I'll talk about what qualifying multifamily is in just a second. 5B is HVCREs, high volatility commercial real estates. Do you guys have HVCREs? Anyone have those? You good? Okay. Generally, the lenders are identifying them. Is that they're essentially, and I won't spend a lot of time on it, but they're construction type loans that do not meet certain criteria that make them higher risk than normal loans. There were banks back in that 2005 to 2013 range that were doing a bunch of construction loans that weren't actually happening, which caused bank failures. So this is kind of the response to that. 5C are non-accrual and past due 90 days or more, and 5D is everything else. So this is a lot of stuff here. This goes back to this first column here, this 5A residential mortgage. So there's two types of residential mortgage exposures. Well, there's residential mortgage exposures, and then within the residential mortgage exposures, there's loans that are eligible for a 50% risk weighting. And for them to be eligible, they need to meet specific criteria. So the bank has to hold the first lien or the first and junior liens with no intervening liens. The total amount of the mortgages can't exceed supervisory loan to value limits, Part 365. The property is owner occupied or rented, can't be vacant, which I don't know that there's a really good way for banks to know this one, but it's one of the rules. And they cannot be 90 days or more past due or on. Or a TDR, but that's done now. So right now, most of your 1 to 4 family loans, your mortgages, your regular mortgages are going to fall into this bucket. If you have first lien HELOCs, they could fall into the 50% bucket. If it's not easy to identify them, you're probably fine just putting them in the 100% bucket. Multifamily is a little bit different. Multifamily has two groups. If they are under $1 million at origination, they're usually qualified and meet the other criteria. If they are over $1 million, they have to meet all this, which we're not going to go over individually, but there's specific rules on, the amortization, the repayment principal, if they're 90 days or more past due. A lot of times, if they're the banks will just push all these at 100%, but if you have a good way to tell the difference, you can separate them out. Okay, so going into the risk weighting, column A for 5A is going to include these loans with just some kind of down and dirty qualifications. And the buckets are going to be, if there's FHA and VA loans, they are eligible for 20%. 50% are going to be most of your 1 to 4 families, as long as they're qualified. First lien HELOCs, qualified 1B, 2Bs, which are not common in qualified multifamily. And then everything else is going to get put at 100%. So 100% is going to include non-accrual loans. It's going to include TDRs, which is going away, any loans that exceed loan to value limits. Questions on that? This is the one that gets wrong the most. I would say out of all the issues with RCR Part 2, this one is wrong the most frequently. HVCREs, these are reported at 150% because they are higher risk. They did change the rules for HVCREs. They made them a little bit more lenient. These are the qualifications. By now, my assumption would be that we've had these discussions. It's been like 7 or 8 years. It was a big deal when it first came out. The way that you sometimes get in trouble with these is the loan, the auditors or examiners pull your loans and they'll pull a file and they'll identify the file as the loan as an HVCRE. And then they'll look at your call report and see that you didn't have any reported, and then they'll start asking more questions. So it's important that you know if you have any HVCREs. And here's just some information about the revisions. 90 days or more past due. This includes non-accrual and anything that was in that 90 days or more bucket. You are able to risk guaranteed portions of loans by SBA, VA, whatever the guarantee is, at 20%. There are some programs that are eligible for 50%. They're not too common, but there's some out there. And then all the other non-accruals go at 150%. And then all other exposures, a lot of times it may or may not be worth it to figure this stuff out, but it could potentially be. So 0%, if your bank has a bunch of loans that are secured by CDs, you can risk those at 0%. 20% is going to be guaranteed portions of SBA loans. It's also going to be any loans to municipalities that is paid back with general obligation funds. 50% is going to be munis paid back with revenue funds, and then everything else at 100%. If you can't tell the difference between these two, you're probably fine just putting them all at 50%. You'll still get the benefit of the lower risk, but you won't have to sort through all of them. Sometimes you have to, like, to figure this out, you have to read the loan contract, and it's a lot of extra work. Questions on those? So all other assets, this is where in column B, we go in and we back out goodwill, we back out the core deposit intangibles, any of the other items that are taken out in RCR Part 1. 0% Federal Reserve stock, accrued interest on assets at 0%. That could be FDIC insured certificates as well as securities that were on that risk workbook. Carrying value, FHLB stock is 20%, and then accrued interest, again, anything at 20%. 50% is going to be anything, securities risk weighted at 50%, accrued interest receivable. You could also include qualified 1 to 4 family exposures. If you have that accrued interest separated out and you wanted to add that in there, you probably could. 150%. Honestly, this amount is probably so small that I wouldn't worry about it. And then the MSR at 250. I had one bank one time. This was one of the most interesting, clever things, and I didn't even know how to respond to it because I think technically he had a good argument. The bank president, he realized that any loan that he had a general business agreement on technically included any cash that the customer held at the bank because it was a general business agreement. So he had the core system develop a report that would tell him all of these accounts and the associated cash. And then he would take that total dollar amount of bank accounts, like cash accounts that they had, and risk weight it at 0%. Because technically that cash was part of the general business agreement that was securing the loan. And I'm like, one, that's a lot of work for not a lot of payout. And two, like, I think he was actually right. Like, if he technically had access to that cash, he could do that, but I don't think I've ever seen anyone else do that or make that argument, but it was definitely interesting. Definitely a lot of work on their end. 8A is BOLI. So if you have a general account BOLI, that just gets risked at 100%. If you have a separate account BOLI, you have to put it in column R and S. And generally, your statement is going to tell you this as well. The reason is if you have certain type of hybrid or separate account BOLIs and the investments within those BOLIs exceed a certain amount individually, then you have to report it differently. But I think most of the insurance companies that work with bank know what these restrictions are, and they don't do that. So you don't have to necessarily worry about it, but your statement will tell you where they should be classified. Okay, we're getting there. I think that was far side. Number 9 is on balance sheet securitized exposures. Does anyone report these? These were, so when Basel III came along, there was a bunch of like, we called them pretzel trups. I don't know what real life called them, but they were like these investments that had different tranches that had different securitized features, and they were a nightmare to deal with. But I think most banks have gotten rid of those because nobody wants to deal with this. What happened back in that early 2000s was there was a lot of banks buying a lot of like investment products that they didn't really understand and probably shouldn't have been bought by banks. And Basel III and having to, like, the impact of having to risk them and what it did to capital kind of discouraged banks from doing that. And eventually a lot of them, they just decided to write them off because they were creating too much of an issue to even have on their balance sheets. Number 10, off balance sheet securitized exposures. These are going to be your credit enhancements from FHLB original or secured, any of the securitized portfolios. And you have to choose a method to risk weight. You have 3 options. You have the 1250 method where you take that amount, you multiply it by 1,250, which is probably like going to be the highest one. Then you can use the SSFA or the gross up. Once you pick it, you have to keep that one. Woolery Win has a workbook that they have issued through the FHLB that helps you calculate this if you need to do that. I don't know that there's any bank I work with that does the calculation that doesn't use that workbook. It's a pretty standard workbook. Letters of credit, these come right from RCL. Standby, financial standby, performance standby, or commercial. These have like a credit equivalent. So financial get reported at 100% of face value, and then you risk them probably at 100%. Performance, we only take 50% of the face value and then risk that probably at 100%. Item 15, retained recourse on small business applications. I think this was a thing the SBA did a while back, but I don't believe they do it any longer. So I think this is pretty uncommon. Repo style transactions. So these are for banks who do repurchase agreements. This was really confusing when it first came out, but what ends up happening is what we're trying to measure is the impact of the repurchase agreement if the bank were to fail overnight. So in this example, and I did take this one right out of the instructions because they did update them so that this was clearer. If you have a repurchase agreement, your customer has X amount of dollars. In this case, the customer has $98,000 sitting in their checking account. We've pledged $100,000 security against this. So at night, the customer gets to keep the $100,000 security and we keep their $98,000 in cash. So if the bank fails overnight, the customer walks away with 100,000. We keep 98. So the difference that's at risk is the $2,000 between what the security is that the customer now owns and the cash that the bank owns. Most banks do a 1-to-1. So you allocate, like you have X amount of securities, you allocate percentages to each so that this amount in column A, column B, and column C are all equal. There's a whole procedure to that too. Like you have to send those to the customer every day. Repos are a lot of work. Item 17, other off-balance sheet liabilities. This would be that recourse again that we talked about in part 1. These are, this is potential recourse we have on certain types of loans. And even though it's not on the balance sheet, we do have to account for it in our risk-based assets. So that's what we're doing here. Some banks actually have a liability set up for this. If you have an actual liability, you don't need to do this part of it. Unused commitments are in 3 groups. We can see the unconditionally cancelable again. The 3 groups are original maturities less than 1 year, original maturities more than a year, and unconditionally cancelable. The portion that's unconditionally cancelable gets risked at 0. So it's like those don't even exist. Under 1 year, we risk weight 20% of those. Over 1 year, we risk weight 50% of those. These numbers here, these 3 should tie out to RCL number 1. Sometimes your software will let you know if it doesn't. I don't think they all have that edit, but some of them do. Here's just some more information about unconditionally cancelable. These are pretty uncommon, 2021 and 22. 26 is the total of, actually 23 and 24 kind of totaling lines where they take everything and pull it down. 26 is where you get the total amount that you're going to multiply by 1.25 to figure out how much of your allowance is includable. If you are not able to include the full amount of your allowance, the remaining amount gets reported on item 29 here. And then that brings you to item 30, which is your total risk-weighted assets, which is what we use to calculate your CET1 capital. If you have secondary market or swaps, you do have some additional reporting to do on the memorandum M2A. So that's the notional principal amount of any of your over-the-counter interest rate derivative contracts. Questions? That's all of RCR in just under an hour. 2 minutes to spare. Okay. Other schedules. So RCE is one of the other schedules, and full disclosure, not my favorite schedule. If I like when I do the call report, I always save RCE and RCO for last because I feel like they give me the most hard time, or I do it first so I don't have to deal with it later. RCE is the deposits, and it also has to tie out to RCO, which itemizes the deposits, which is where I usually get the most heartburn from. If you have good core reports, this is a lot easier. But you should be able to tie these out. And again, this is another scenario where I strongly recommend using some kind of a workbook to be able to do this, because if you just have deposits on your core system, life is easy, right? You can just pull the deposits off the core. If you use CETO or ICS or CDARS or have like any sort of premiums or discounts from mergers, this gets a lot more complicated. So we'll kind of walk through just the process of how it works. Just like the loans, you should have application reports that you should be able to reconcile with the general ledger. When I set this up, I generally will tie out the balance sheet numbers, but use application reports so that I can double check that everything reconciles.
Other items that get reported as deposits, we talked about this way earlier this morning. If there's any non-post or suspense, these are easier to put where they belong because a lot of times we'll have DDA non-post and savings non-post and CD non-post. So you just can net those general ledgers out and we're usually pretty good there. Escrow go in there. And then any of the payments that are collected for others that are for whatever reason in a general ledger account and not in a checking account. Okay, so the reason this one gets hard is we have to slice and dice. So on RC, we split deposits into interest and non-interest earning. Now we have to split them into transactional, demand, transactional. So typically just come in and take money out of pretty immediately. It's usually checking or now accounts. There's some situations where savings might be thrown in there. HSAs, if they're checking accounts, would go in that group. Pretty much anything that you could just go up to the window, write a check for, you're good to go. Demand deposit accounts are, and we'll go through some more details on demand deposit, but demand deposit are essentially any account that the bank does not reserve the right to require 7-day notice for withdrawal. So these would not include a now account or a money market account or any account like that. Typically, these are just regular deposit accounts. It doesn't matter if they earn interest or they don't. And then non-transactions are money market savings, CDs, savings club, so on. And here's some more details on how, like, specific definitions. Reg D changed last year, and that kind of governed what we thought of as transactional demand deposit. But the call report rules stayed consistent. So for the purpose of a call report, it represents funds for which the bank does not reserve the right to require at least 7 days written notice. So that's it. I do see this item, demand deposit, that gets reported incorrectly quite frequently. And there's some more about Reg D. So now we've split them interest bearing, non-interest bearing by transaction, non-transaction. Now we have to split them by who the depositors are. So, the first group, and this is probably the biggest group, this is the individuals, partners, and corporations. I used to go to banks and I'd see like balance sheet deposits that would say, or the balance sheet accounts that would say IPC deposits. And I was like, what is IPC deposits? And I couldn't figure it out. And then finally it clicked. They meant individuals, partnerships, and corporations. So I was really pleased with myself that I figured that out. That's going to be the biggest group. The bank's accounts go in there, like official checks, money orders, anything like that go into that category. US government, these are pretty rare. Could happen that you have US government accounts, but not super likely. State and political subdivisions, these are your municipal accounts. If you set your core system up to tell you what these accounts are, life is going to be easier, because if you have to search for them individually, it's a lot more difficult and not as accurate. Commercial bank and other depository institutions, it's possible, like if you have any sort of listing service deposits you have on your books or anything like that, you're going to have those. And then foreign countries are pretty uncommon. Anyone have ICS or CDARS? So with ICS and CDARS, you go through the whole process of mapping everything out, and then you look at your ICS and CDARS reports and you have to move things from here to there. Because what happens with ICS and CDARS, well, first of all, these are reciprocal deposit arrangements. This is a really efficient and effective way to be able to offer your customers with a safe way to deposit over $250,000.
What happens is at night, the money, the funds in those accounts that's over 250 gets moved to another bank, and it's spread across a number of different banks, so that in essence, it becomes insured for $250,000 everywhere it goes. In return, you receive other banks' deposits that are placed with you so that they're insured the same way. You can do this through CDARS, which is the certificates, or you can do this through ICS, which is for the money market and checking accounts or savings accounts. You get a report that tells you what needs to be reported where, which is all fine and good, but you do have to make those adjustments to the other areas. And it's not to say, like, you could send out municipal deposits, but they're going to send other deposits back to you. So while you send out municipals, they might send out depository institutions back to you. So you have to report whatever it is that they sent to you, which is what they put. Questions on those? If you don't have those, it's probably worth considering if you do any sort of like commercial deposits or large municipals, because it's a really effective way to be able to get big deposits. Okay, so now the memorandum. The first one is total IRA accounts. This is another one. It only gets reported in June and December on the 05 one. I don't know the benefit of not reporting those in those 2 quarters. Those 2 quarters are, but we don't report them then. You should not include HSAs or educational IRAs. These are strictly regular individual retirement accounts. M1B through M1D are that's broker deposit information. And this is usually going to, these are deposits you've obtained through a third party. They're not listing service deposits, they're actual broker deposits. These could be through CDARS as well. They might not be, you can do broker deposits through them or reciprocal. It could be through another broker. Either way, you want to make sure that you know the dollar amounts and the maturities. One of the things I will warn, where is it at? I don't think I have it here. With this one, brokered CDs, you have to determine if they're over and under 250. It's possible to get a broker deposit for like $2 million. One CD for $2 million. Now, that one CD on its face appears as if it's over $250,000. But it's important to look at whatever your agreement is, because it's more likely that that CD is made up of a bunch of $1,000 certificates. And because it's made up of a bunch of $1,000 certificates, it's actually reported as under 250. So you're gonna have to reclass that one. I would say 100% of the time, if I see a brokered CD for, over $250,000, it's probably, and it's reported as over 250, it's probably reported incorrectly, because if you follow up and get the documentation, it's really under 250. Because if you think about it, it's highly unlikely they're going to deposit more than 250 in one financial institution, unless it was some sort of custodial arrangement. So double check those if you have them. Just some additional information about broker deposits. There's some rule changes that came through. There's some good FAQs out there. The changes that happened most recently have a lot more to do with fintech partnerships. So those are, they probably aren't going to apply to a lot of the banks, our community banks. Preferred deposits, I don't know what the rule is. You guys would have just had to report this in December. I don't know what the rule is Michigan, if municipalities are required to pledge securities. It's kind of hard to find this information too. You have to like look through state statutes. But if there are actually not that many states that require this, I know Ohio does, I know Montana does. You have to report anything that is over FDIC insurance limits for state and municipal deposits. M1F is deposits obtained through a listing service. Usually you get a report from Quickline or CD Rate, Quick Rate or Rate Line that has these accounts in there. It kind of tailed off when we were making all kinds of cash with the PPP loans, but I'm thinking they're going to start popping up again. Sweep accounts. Does anyone have sweep accounts? If you have ICS and Cedars, you may have sweep accounts. You would know this because it would be on your statement. So just double check your ICS and Cedar statement to see if there's anything that gets posted as a sweep. I don't know that I've seen them, but they started popping up a few, like last quarter and the quarter before. I've started getting questions on them, but I don't know that I've noticed them on there.
I can elaborate.
Yeah.
I believe-
I'm not sure, but if it was considered a sweep account, you would see on your statement at the quarter end, you would have something to report on this line
the statement
from ICS. Yeah, they would tell you if it's a sweep account. And I'm wondering if, because this was relatively new last year, I'm wondering if they just kind of caught up with that reporting is my thought, but it would be on those statements. And it would stand to reason that that's the case because there are specific criteria. The one criteria is there has to be an agreement with the customer. And there has to be funds actually moved off of the bank's book. So that would make sense because technically those funds are leaving the bank and you're receiving reciprocal funds. So based on the two criteria, I feel like it does meet that qualification, but ICS would definitely know if it was, but I do think that's new reporting. So if you haven't looked on your ICS statement or your CDAR statement, take a look because you might have something to report there. And this just kind of goes into the different type of sweeps. And again, if you have ICS or CDAR, it's going to classify this where it belongs for you. That's one of the other benefits of ICS and CDARs. They do all of that work for you, which is, they do a great job of it. I don't actually work for them. I just think they work really slick and they're a really good option to have. Okay, so item M2 is splitting up all the non-transactional. We split it up between money market, savings, time, 100,000, 100 to 250, over 250, and then IRAs over 100. This is kind of, when we got the updates to the call report, we eliminated a lot of the $100,000 thresholds because it used to be we have to report all different places like this. And then when we changed to the 051 form, they compressed everything, but we still have to report 100 to 250 on this schedule. And the reason is because this is these are the inputs that the Federal Reserve uses to calculate the money supply. And it's a federal law that they need to use these stratifications, which is why we still have to report them this way until they change that. This section here this is the part that I find I chase my tail the most on. So I build in a bunch of checks in here to make sure that I can find like, okay, this ties to this, this ties to this, this ties to this, so that I know that everything balances when I put it into the software. Because it's much easier to deal with it and fix it than it is to chase and edit. Questions on our CE? If you are, is anyone doing CETO still? So if you're doing CETO, there's some things that come along with that. You just have to make sure that you're moving those funds as well, which you're probably doing here. You want to also make sure you're moving the averages for CETO as well on RCK, and you're also moving the income on RI. CETO is a program that allows you to reclass deposit funds into non-transactional status. And back in the day, I think it helped with your reserve requirements. I think the necessity for it is kind of gone away in 20. Let's start over. Yeah, I have quite a few banks that are still using CETO, even though it's kind of like it's a weird, like exactly what you're saying. It's like people aren't ready to let go of it yet because we don't know for sure. Yeah.
Do it.
Yeah, that makes sense. And you're right. The reports that spit out are pretty clean and easy to work with. It's definitely probably easier to go that direction. I do have a few banks that are just like, we're just keeping it and we'll figure it out. Okay, RCO. So RCO has a bunch of kind of random stuff that appears random, but it's all related to the deposit insurance and your FICO assessment. So the first item is your total deposit liabilities before exclusions, and the exclusions are rare. Total deposit liabilities includes the actual deposits and any of the associated accruals. So you have to add both of those together. Item 4 is the average total assets for the quarter. This should be the same as what we calculated on RCK. We do have to select an averaging method. Most banks have selected daily averaging because that's what your core system does. If your core system doesn't do it and you do it manually, you might have chosen weekly, but I think you hit a certain threshold. Yeah, $1 billion, and you have to use daily regardless. Okay. This is kind of a sleeper. It's been quiet. We've been either correctly doing this or incorrectly doing this. Either way, the system's been happy with it until last year. When the AOCI lost its mind, and that threw everything kind of in a tailspin, and I would get probably 10 calls a quarter on this edit because it says that they're calculating their tangible equity incorrectly. So the average tangible equity for the quarter has to be consistent with how you calculate RCR Part 1. And generally, you have to go back. So for December, you would have had to pick October, November, and December balance sheets, figure out what the equity was, divide by 3. There's no other real good way to do it unless you guys have a good way that you can think of. The important part is to make sure that you're including everything that needs to be included. So you're going to start with your total equity. You're going to take out goodwill, take out other intangibles, take out the NOL carry forward, take out the AOCI, or add back in the AOCI. any sort of non-includable MSR and any sort of non-includable minority interest. And we didn't talk about minority interest because it's pretty rare, but if your bank had one, it would get included in here. You take those three, divide it by 3, and that's what gets reported. If you're not doing it correctly or you're including your AOCI, you're probably going to get an edit because now it's going to be so far out of whack that it's going to throw the thresholds off and it's not going to do what it's supposed to do. Questions on this? You guys had any issues with it? I don't even know where people find my information to call me to ask me questions about this every quarter. There are so many of them in the last 6 months. Okay. This is 6 through 11 are probably incredibly rare. I don't think anyone's doing any of these. They're pretty uncommon for community banks. This is the memorandum. So in RCO memorandum 1A through 1D, we have to go in and break apart our deposits. So now we've done interest, non-interest, we've done transaction, non-transaction, we've done government, whoever the depositor is. Now we have to separate them we have to separate them out into 2 piles, IRA, non-IRA. And then within those 2 piles, we have to separate over 250, under 250. And then we also have to report the actual number of accounts. So this gets a little confusing because we now also, in addition to that, have to include the accruals that go along with them. If you have a report that gives you this information, that's probably best. If you cannot figure out the accruals, like if you don't have a report that tells you what the accruals are over and under 250, my practical expedient recommendation is to allocate it. It's not the best way to do it, but sometimes you just don't have that information. So if you say, 20% of your total CDs are over 250, you apply 20% to your accrual and then allocate it out. I know there are some core systems that you just can't get some of this information, especially the over under 250. So that's a way to get to where you need to go. Not ideal, but okay. Any of you guys have trust departments? Okay. Even if you did, I'm pretty sure somebody else completes these generally. So this is only completed if you have a trust, if you do trusts. So if you're doing the 041, you're not going to do the SU schedule. One of the things that happened when they converted over when they created the 051 form, they took out some of the schedules and portions of the schedules that weren't going to be relevant and just pulled a few lines off of them that are. So we talked about RCL earlier today and the derivatives and all of that information. Instead of having to do that full amount on the SU form, you just have to report whether your institution has derivative contracts. These are generally going to be if you have swap arrangements or if you have any sort of a secondary market loan contracts that are considered derivatives. And this gets a little bit confusing. The ones that get reported here are generally commitments to sell secured 1 to 4 family residential properties that meet ASC topic 118. So what the heck does that mean? It's generally your best effort loan commitments that you are going to sell is what gets reported here. I don't know why there's no clear place. They just tell you that. Like, I feel like it's pretty simple what actually goes on here, but they make it so complicated and difficult that it's really hard to understand. But if you have secondary market loans that you're selling, you can sell them as a mandatory contract where you promise X amount of loans to the investor. And if you don't give them, that's where the derivatives created the fair value adjustments on those mandatory contracts. You also have best effort contracts, which more of the banks use. And the best effort contract means we'll try our best to get these loans and get them to you, but we're not required to provide a specific amount. I want to say those are considered, I shouldn't even say, I think it's the forward contracts are the best effort. And the options are the mandatory. I can find out if you need to know. But generally, if you have best effort contracts, this is the ones that go there. Item 2 is secondary market activity. If you're reporting that, you may have had these requirements met last year because 2020, 2021, and the very beginning of 2022, it's possible you were selling over $10 million in mortgages every quarter, but there's a good chance that that's tailed off or it's going to be tailing off. And once you no longer meet that qualification, you no longer have to report this. This is also reported on RCP. I didn't put one on here, but this information broken down is reported on RCP if you're doing the 051 form or 041. Item 3, assets and liabilities measured at fair value. My best guess is if you're measuring things at fair value, you're probably more complicated than the 051 form. So you're probably going to have to use the other form. And I didn't mention this in the beginning, but there are scenarios. I work with a bank that is, when I started working with them, they were probably like 300 million. So they weren't a huge bank, but they were super complex in what they did. And because of their complexity, the regulators required them to use the 041 form because they needed to have that additional information about what they were doing. So even though they were small, very small, much smaller than 10 or $5 billion, they still had to do the expanded call report. And when you do things like, you guys are probably reporting at fair value, correct? So if you're doing a lot of secondary market lending or anything like that, there's a good chance you're reporting at fair value, and it makes more sense to do the 041 form. But that's where this gets reported. You do not have to do it if you just have available for sale securities, but if you do have them, they get reported on RCQ. This one causes a lot of confusion. This is RCS on the 041 form. It's reported a little bit differently there, but this is where you're reporting seller enhancements or recourse or any loans that are being serviced for others. So item 6, does the institution have closed-end 1 to 4 family mortgages for others, or does it service more than 10 million in financial assets for others? So if you say yes, then you just write down the entire portfolio that's being serviced. If you have the credit enhancement for FHLB, those get reported, just the entire amount of that portfolio gets reported as total outstanding principal balance of assets sold by reporting institution with recourse or other seller enhancing, but not securitized. So that would go on 5A. Okay. The rest of these are pretty rare, and I don't think you would have them. Any questions on SU? I noticed how I stopped putting question slides up here toward the end. We're getting toward the end, and I'm like, yeah, we're not going to do questions. No, I could, if you have questions, I'll answer them. Okay, so we're getting closer to CECL. So the income schedule. I did similar for the income as I did with RCK, where we're looking at the RI line is over here, and then this column here is the associated items that go along with the income item. So when we talked about RCK back in RCK section, we talked about how a lot of the edits come from between income and averages. And this is where that's coming from. So what it's doing, what the edit's doing is saying, all right, I'm going to look at your loans secured by 1 to 4 family residential properties. I'm going to see this amount here is income. And then I'm going to go to RCK and I'm going to see what loans secured by 1 to 4 family properties average was. And then I'm going to divide that out to see what the yield of your portfolio is. And that yield needs to be between X and Y. If it's outside of X and Y, we're going to say something, we think you put something in wrong because your yield is much higher or lower than what the market is. Now, with that being said, there was a bunch of edits like that came out when the interest rates kind of fell, because what ended up happening is the overall portfolio of 1 to 4 family ended up much lower than what the thresholds were, because the market just dropped so fast with the rates. But normally this is an indication that either, if you get an edit like that, it's an indication that we either entered the income incorrectly or we entered the average incorrectly. There's cases where it is legitimate, but it's definitely worth looking at. So this is just kind of the reference for the loans, and this is the reference for the securities. I think I want to have some details here. So under the interest income, this is going to include not only interest income, it's going to include any of the origination fees. It's going to include late fees, prepay penalties. It's going to include any sort of premiums or discounts related to those specific loans, either from purchasing or in a merger or purchasing outright. Anything that you would include in your loan yield would also get included here. What you should not include, and I see this, I usually, when I test RI, and I know you're doing secondary markets, I generally will test this, but any of the origination fees or anything else related to loans held for sale does not get included here. That is a completely separate group of income. We're not holding these for investment, so they're not going to get included in the yield of our portfolio. And then any fees for servicing loans also do not get included here. And these should be broken out by, I don't have it here, but it's up here. They should be broken out by the type of loans they are. So the easiest way to do this would be to have income statement accounts that mirror this. Like, you don't have to have an income statement account for every type of loan, but like you're probably going to want to have, oh, sorry, I got too wild. You're going to want to have one for these groups. So loans secured by 1 to 4 family residential, anything related to those loans, late fees, interest income, prepayment penalties, should be in a group for that. What I sometimes see is commingling. So you have your commercial mixed with your consumer, mixed with your mortgage. And then it's really difficult to figure out where those loan fees go. And that really, again, for the call report, is it a huge deal? Maybe not, but it does impact your yields on your loans, and that could impact your ALM, and that could impact other things. So making sure this is set up on your income statement nice and clean is going to make it a lot more accurate
through all the uses of this information. Interest and dividends on securities. I usually will use the bond report, RI section, and then reconcile that back to the bank. Sometimes I regret that decision, but it's usually the most accurate way to do it. And in theory, your bond report for RI should match your balance sheet, so it should be accurate. Interest expense. So this gets broken in between deposits, transaction accounts, and non-transaction accounts, and then we have to split it. This is another one of those items, time over and under 250. If we don't have that information available, we might have to allocate that to get to it. Ideally, we want our system to generate that for us, but if we can't, we can allocate it. Fed funds, and then other interest expense. Any questions on these? Provision. So this is we're gonna talk, I didn't put a note here, but we're gonna talk about RI4. This is gonna have to look a little bit different after CECL, potentially, depending on what kind of parts and pieces you have going on. But this is gonna include it's gonna be the provision for the ACL, not just the loans and leases. So we'll have to, we'll talk through those. And then non-interest income. Those different groups are broken out. I usually like to test some of these because fiduciary activities are, if you have trusts or any other fiduciary stuff. IFB is service charges on deposit accounts. So this one's interesting. I find that we report this one incorrectly a good amount of the time. This includes fees that are directly charged to deposit accounts. And the part that really is impactful that gets incorrectly reported is we include interchange fees in there. And interchange fees are the fees that we receive from customers using their debit cards. So they go to a merchant, that 3%, that gets partially passed along to us. That is not being charged to the customer's account, so it's not a service fee. So if you, and I can tell right away if you're doing it, because if I look at you compared to your peers, yours is way higher. And it's usually way higher because the interchange fees. So that should be other income. Net servicing fees, if you have mortgage servicing assets, these are the fees that you earn on a monthly basis for servicing those loans. You also would net out any amortization expense on your servicing asset through this line as well. 5I, net gains and losses on sale of loans and leases. This is where you would report any of the income or loss generated from selling loans. We haven't had to use this for a while, but net gains, losses on ORE sale. This is actual gains or losses when you sell the ORE, as well as write-downs. I just got this question yesterday. Somebody wanted to know if they could include rent and other expenses, if they could run the expenses through the general ledger for the ORE gain or loss. And the answer to that is no, it's an expense. It's an expense. It's been nice not having ORE. Like, life has been so good without ORE. Life's going to get so much more difficult here in the next year or so. I'm already starting to see it pop up on books again, and we'll have to have these discussions. But for now, just the write downs and the gain or loss on the sale.
Gain or loss on sale of other assets. So this could be anything that was repossessed that wasn't real estate. It could be, you know, we've depreciated a bunch of desks and we sell them. It could be any assets that the bank sells. Non-interest income. So this is not an exhaustive list, but just kind of an idea of what we normally see in this group. So safe deposit box rent, any fee, letters of credit. So normally when you do a letter of credit, you charge a fee for the letter of credit, and that fee should go through non-interest income, not through the loan yield. Notary interchange fees, ATM fees, checks, rents from ORE, early withdrawal penalties. Early withdrawal penalties, these are tricky. They're probably not material. My thought would be that in most cases, they're not going to exceed the accrued interest. So we don't necessarily need to, it would be uncommon that you'd see it here, probably net against the interest. And then anything else we need to put in here. 6A and 6B are realized gains or losses on sale of securities. Generally, you shouldn't have any gains on the sale of held to maturity. We shouldn't be really selling those. You could have gains or losses on the available for sale securities, and this is going to come from your investment report as well. Now we get into the expenses. Probably the biggest expense is salary and employee benefits. Again, highlights of what goes in here. Obvious stuff, salaries, temps go in here, cost of temps, any sort of retirement, deferred workers' comp, cost of medical services, vacations, employment taxes, anything related to that. Premises and fixed assets, a bunch of stuff goes in here too. Anything related to bank property and vehicles. Seven C1 and 7C2 relate to impairment on goodwill and core deposit. Every once in a while, you should probably look at the goodwill and the amortization, the core deposit for impairment. It won't change very often. Goodwill is more rare. The intangible, the core deposit could change more frequently. And then all the other expenses. Here's a list. I'm gonna just go through. The A is a subtotal. 8B. This is where we would put the mark-to-market adjustment for our equity securities that get reported on RC. And then totaling applicable taxes. And then item 10 is our income loss after taxes. And then that floats down to 14, which is net income. There's 11 and 13 are pretty rare. These are the discontinued and minority interests, but you would know if you had those. Just a couple tips. Structure your income statement. Whatever works best. If you're going to go through like a core conversion or something like that, I would suggest setting up your accounts so that they mirror the RI schedule. You can always add accounts together, but you can't pull them apart. So I would err on the side of like the very minimum number of accounts would be like what is reported in RI. You could then, if you wanted to, break those down into smaller accounts as long as you can roll them up. I've seen a lot more banks. How many of you guys have interest on the top and other on the bottom instead of income on the top and expenses on the bottom? So I'm starting to see more income statements at banks where they actually mirror the interest income and then the non-interest income. And it's easier to tie it out to the call report and kind of see across the board what's going on instead of having to manually recalculate everything. The memoranda is M3 is pretty common. If you have any loans to municipalities, this is where the income would go. If you have tax exempt securities, this is where the income would go. This would come on your bond accounting as well. FTEs, this usually comes from HR. And then we'll wait on that. All right. Anyone want to take a break? All right. We're doing pretty good on time. Do you want to take 10 or 10 minutes, 15 minutes? 10 minutes will get us to 5 to 2, 15 minutes will get us to 2 o'clock. 10? Okay, we'll come back at 5 to 2. I'm thinking around 3:30, depending on how many questions. Yeah, because we just have the rest of the income statement and CECL to talk through. So we're making good time. Well, you guys didn't ask any questions, so here we are. Maybe we'll have questions for CECL. You're just saving them for the end. What did you bring me a mug? Like thinking about that, I'm like, oh, I should grab you one of those. And then I can do this. Um, yeah, sometimes it takes a minute to wrap your arms around what's happening.
Well, 'cause a couple of years ago, we started with SWAT. But we manage all of that through channel. And so they sent me the everything. They're amazing people. But now recently, fourth quarter last year, we started a relationship. Updated home commitments. We saw them, right? This, that, and the other thing, when they take down securities or put out, I don't know exactly what they're called. Basically, they're taking out something mortgage back, like a mortgage backed security, forward contract. I think that's what they refer to. We don't ever. Because basically, as a loan closes, then it comes off. Behind, so it's a type of derivative. I'm not fully understanding. For us, but they're helping to leverage the interest rate risk with some type of investment. And vice capital is not counting. Yeah, they're like, well, it's gonna hit your balance sheet, it's gonna hit your income statement. That's about as deep as they go. I was like, well, thanks.
Yeah, we've been spent, I keep telling everybody, okay, we need to getting. You know, we've got. Guy that I work with. He's accounting. And it would be like, well, that line right there. I'm like, come on. But yeah, so it's really, and then talking. It's the order, but that's pretty outstanding to help their learn. Yeah, this might be just like. And I can. Go say that. Thing. Secondary market. And they are. They're just. Yeah. Somebody raise your hand and tell me. So. You know, you're saying something that sounds exactly the opposite of what. Okay, these, I mean, I don't need to just. This is what it looks like. This is what happens. Power of the smaller things. I think I work with. Yeah, something that. Better, you're better. So. You do. Why would you do that? Why?
It has to be a money maker.
But,
Otherwise-
okay, a money make, this thing makes so much money and get it. Economy's changed and this can be an issue with. Market. figure this out, but a British pound investment, really, what are you gonna do with that other than take it off this time? And I think you're not. You're only. Gonna do so- Yeah, that's. Okay. There might be. It can be done. Exactly. And the examiners and the president. Is going next time. And they have like. I guess I do. Yeah. It doesn't get like that's what's gonna happen. Most times I just say. Raj, everybody's like fading fast. This is like. Okay. We're in the home stretch. Okay. Way back when we first started this morning, I said, when I started the call report, I did RC, RI, and then RIA, which is changes in equity capital. And RIA is the equity roll forward. If you cannot get this to balance, you're probably not gonna be able to file your call report. Like this has to balance. The items that get entered in here are pretty straightforward. What we're doing is we're taking the 12/31 of the prior year's equity and we're adding in the net income, any sort of changes in dividends or treasury stock, or if we had a business combination, the change, not just the AOCI, but the change in the AOCI from 12/31 the prior year. And then that gets us to what our capital is this quarter. So that should be pretty easy. Most of the time it is, but there could be things that are going on. One of the things could be the calculation of the other comprehensive income. I put some examples on here because for whatever reason, when I first did the call report, it confused me a lot.
So the idea is you take 12/31 of the prior year. You take the current year less 12/31 of the prior year, that is the change that gets reported in 10. Double check this number to make sure it's okay before you chase down other things if this doesn't balance, because this one's usually the culprit. So if it doesn't balance, like we might be tempted to just put something in on line 2. Cumulative effect on accounting principles and corrections. We can't do that because if you do that, you will get a call from your analyst and she will ask you, or he will ask you to explain what you did. And if they don't like your answer, you're going to have to fix it anyway. And your answer, unless it's actually your CPA firm came in or your regulator came in and said you had to run an entry and backdate it to the prior year and you didn't amend that call report, you shouldn't have anything on line 2. And anything you put on line 2 has to be carried through the entire year because you're adjusting the previous year. So, okay, so if it doesn't balance, some of the reasons why is your net income correct? That's probably the first place I'd look. Were there capital stock transactions? Did something happen with treasury stock? Were there exchanges? Did we declare dividends? Did we calculate the AOCI correctly? Was there transactions that were backdated to the prior year? So March 31st, that's usually going to be the culprit. Something for some reason was backdated prior to 12/31 and it changed the end of year amount, which is going to prevent us from rolling forward. So those need to get resolved. Once this balances though, you're good, everything's happy. And then your income statement, your balance sheet, you're all ready to go. So I skipped over the allowance schedules because we're going to get back to that with CECL, but we're going to look at RIE and that's the explanations. There's a couple things that get reported here. Any non-interest income that is greater than 100,000 and exceeds 7% of other non-interest income. Same for the non-interest expense. There are specific items that are on there for you. So some of them that are always going to be on there for expenses are going to be like data processing. There could be other things that are going to be really expensive. So those get tied out to the RI schedule. If you're using the 041 form, you only do that once a year in December. If you're using 051, you do it once a year in December. If you're using 041, I think you do it every quarter, don't you? Yeah, I'm pretty sure you do it every quarter. There are fill in the blanks. Again, just be careful what you're filling the blanks in to make sure that it's descriptive, but not too much information. At the bottom of RI, there are some, and we'll talk about these when we look at CECL. There are a few areas that are going to be for explanations. So on RIA, if you do put anything in that cumulative change adjustment number 2, or on RIB for the allowance, there's a similar line item on that roll forward. You're going to have to write an explanation for that. And we'll kind of talk about that when we talk about CECL. Okay. Okay, so accounting topics, CECL. So I broke this down into a couple of categories. The first category is general ledger accounts, because I'm a firm believer that if you set up a structure correctly, it'll be easier to do all the other stuff going forward. So making sure you have the correct general ledger structure is going to help you when it comes to reporting. It's probably better to have more accounts that you can aggregate up than less accounts that you can't separate out. We're going to have what's called day one entries. These are gonna be the entries that we should have made January 1st. Has everybody made those entries? Yeah. Okay, so you already went through all this. So if you haven't made those day one entries, they are gonna need to be made before March 31st so that they can be on your first call report. And then the day two ongoing reporting, and then some information about the phase-in transition provision in case anyone's interested in figuring out if they need to use that. Okay, general ledger accounts. These are my recommendations for general ledger accounts. So what I did here is there are balance sheet and there are income statement. And the balance sheet accounts are based, and I also put in the center where they get reported and how they impact the regulatory capital. So the allowance for credit loss, this is your existing GL. You should already have one of those. What you might need to add, depending on your situation, is going to be an allowance for held to maturity debt security if you have those, if you need to carry a reserve for them. And then if you have any, what we historically considered OTTI securities, you're going to want the allowance for AFS debt securities. All three of these are includable in tier 2 capital. You're going to also want, if you already have PCI loans, you probably already have a purchase credit deteriorated reserve. How we use that is going to change a little bit under CECL. And then the reserve for the off-balance sheet exposures. You may already have this account as well, but if you don't, you're probably going to need to create it. And these are the reporting for each of those GLs. Questions about those? Obviously, if you don't have some of these items, you wouldn't need the associated general ledger accounts, but if you do have them, you're better off creating that structure right up front. Income statement, expense accounts. The first one is the provision for credit losses. That is your current provision, so you probably don't have to make a new GL for that. But you're going to need a provision for each of the accounts up here. So you're going to need a provision for held to maturity, a provision for AFS, and a provision for off-balance sheet credit exposures. And this is where they get reported and on the RI schedule, and this is where they get reported on RIB. And we'll talk through each of those. Okay, so the day one impact, and let's take a step back before we get into the weeds. So you have already run your CECL model for 12/31. You know your current allowance for loan loss reserve is X. And your CECL model says your ACL should be Y. Whatever the difference is between what it is now and what it needs to be, that adjustment is going to be your day one entry. Okay. So until CECL, we've only done column A. Column B and column C have been there for a while, but they're grayed out. So the way this is going to work is we have two parts here. This right here is going to be our 12/31/2022 balance. And then any recoveries, any charge-offs, any write-downs, what our provision was, and then our adjustment. So that day one entry, that adjusting entry is going to go on line 6. And then this amount should agree with it won't agree with anything anymore. We'll get to that.
Because now it doesn't tie out directly. We have to add a bunch of stuff to it before it ties out. So. Trying to see it sideways. Okay, so this is where our day one entry goes. Now, if we have any sort of held to maturity reserve or available for sale reserve, we're gonna start with 0 here. And under the adjustments, we're gonna include the adjustments here. If we need to add, probably wouldn't need to do anything with the AFS, but if you have a held to maturity, you might need a reserve on that. And that would go here. So then your ending amount is whatever your reserve is for your ACL for the held to maturity. Now, it's important to make the distinction. Your day one entry is going to run through retained earnings or undivided profit, not through the provision. So what the reason it's going to be done like that is because say you have to increase your allowance by $250,000. They don't want on January 1st for you to show a loss of $250,000 because you had to fund your allowance. So it's going through the undivided profits. Okay. So this is the allowance side of it. Because we entered in that adjustment, we now need to go to RIE at the very bottom, and there's number 6 is adjustments to allowances for credit losses. And then we can select effective adoption of credit loss methodology on allowances, CECL, and then we put that amount there. So now the adjustment that we made is tied to this, and we have an explanation for it. You're going to likely have to include this adjustment for the entire year. Okay. So the retained earnings, undivided profit, the undivided profit side of it is a little trickier. So from that amount that we entered in right here, if we don't have a deferred tax asset, that same amount gets entered in line 2 of RIA. If we don't have a deferred tax asset. If we do have a deferred tax asset, we're going to split that into taxable and deferred. So the taxable portion is going to go here. Because when we ran the entries, we ran the taxable portion to retained earnings, and we write the deferred portion to our deferred tax. So the only adjustment we need to make on RA to get this to balance is going to be for the amount that we ran to undivided profits. Questions yet? Comments? Okay. So now, just like on RIB, we have to explain our adjustment. And if we go to RIE, the explanations, and go to number 4, cumulative effective change of accounting principles on RIE number 2, we're going to do the same thing. We're going to just pick effective adopting CECL and then enter that amount in 4A. So now our equity and our allowance should roll forward. So these I have written as day 2, but they're going to be day 1 also, but this is going to be ongoing.
So the way we report things is going to change a little bit. Our provision amount on line 4 is it's not going to be provision for loan losses. It's going to be provision for ACL or whatever the terminology is going to be. But it's going to include any provisions that we ran for loans, off-balance sheet credit exposure, held to maturity, available for sale, and then any other financial assets, which would be probably pretty rare. So this is where, if we go back up here, we have all of these separate GLs. They're going to all get added together and reported on RI4. So going forward for our provision, this is going to be the 12/31/22 AL balance. For all of 2023, this is going to be 0, but it'll carry forward for subsequent years. We're going to add in any recoveries, take out any charge-offs, any write-downs, so on. And then in this section, we're going to put just the portion of the provision that is related to the loan. So that's going to be that GL just for the loan. Then same thing, held to maturity. This is going to be the provision for the held to maturity. This is going to be the provision for the AFS. So if we add up all of these adjustments, they're going to equal we have to add in one more. This is where it gets super confusing. So this is the held to maturity, the loans, and the available for sale. But we know that it also includes that provision amount also includes off balance sheet credit exposure. So in order for us to balance back to number 4, we have to find where the unused commitment reserve is. So if we go down to the memoranda, that's where we find the provision for credit losses on off-balance sheet exposures. So now to get to number 4, we have to take M7 and then number 6, column A, B, and C. So if we go back up here, that's what all of this is. So these 4 equal this. Now, I mean, if you have all of these, it's going to be more complicated, obviously. The reality is you're probably just going to have, you're just going to have the ACL and this provision for off balance sheet. If you have HTM, you might also have this one. So if you have a call report template, you're probably going to want to be in a position where you can try these out separately so that you know that they all work and balance together. Okay. So there's a few more things. So as we work through the other schedule, reserve on held to maturity, there's there might not be any, but you need to put some effort into figuring out if there is or there isn't. I don't know, those of you who have held to maturity, what have you done? Have you guys figured out if you have a reserve? You don't? Okay. Who else has held to maturity? No reserve. I'm curious to see what the feedback is going to be on that because there's not a really good way to figure this out. There's a firm that I use to do valuations, and one of my clients used them to value their held to maturity, and they came back with like a $2 million reserve. Was completely bananas. So I'm not sure what methodology they used. Their whole allowance was less than that. So that did not seem realistic, but we're not really sure. I do know some of the bond companies are helping with that. I feel like there's a couple of them that give information that could be helpful with this, but I don't know that it's been a priority. The priority has really been the allowance for credit loss, not so much this part of it. And the reality is the idea that, I mean, if you have agency securities, you're probably okay. You can make a really good argument that the Federal Home Loan Bank or the treasuries are not going to default. But when it starts to get into like municipals or corporate securities, that might be a little bit different story. So then, you know, how are we going to determine this? So I think we'll have more information as the examiners come out and as they start giving us feedback, and as things get published, they're like, oh, hey, we need to have a reserve on held to maturity. What does that mean for banking? Can you give us any practical expedience, anything like that? And then the reserve on the available for sale, that's what we historically have called OTTI, or other than temporary and impairment. It historically moved through the income statement as a write down, but now it's going to be carried as a reserve. These could be more common as the economy starts to turn. We could start to see OTTI situations. You already likely have procedures in place to identify OTTI loans. The difference would be, instead of writing it down, you would put it in the reserve. Go ahead. I think so. The reserve for the available for sale is going to be virtually identical to OTTI. So however you've historically determined if a security had OTTI, I think applying that methodology and saying, okay, the OTT write down would have been X, instead of it being a write down, it becomes a reserve. But in the case of available for sale, that only happens if there's that other temporary impairment, which could happen. Yes, it goes through the provision, not as a write down. Yes, it does impact. Yes. So if you have any of these OTTIs, you're going to probably want to run them through undivided profit instead of, and that's a question I keep getting asked, and I'm getting like, this question's making me a little bit irritable, because it's like, okay, guys, we're not gaming the CECL system. We just need to come up with a good amount, because the reality is with CECL, you had to create a model that was going to most accurately and appropriately impact or predict the potential loss in your credit pools. So then I get a lot of the banks are coming to me and saying, well, Danielle, what if we do this model, we take it through undivided profits, and then the economy goes terrible and we have a bunch of loans default? And my answer to them is, one, the reality is your ACL isn't going to be where the problems are. These random loans that are on the books are going to be fine. The problem is going to come from the fact that you didn't look at your specifically impaired loans appropriately. Your credit administration didn't correctly identify loans that should have specific impairments that are troubled and could potentially default. Those are the ones that are going to create issues for you. And those are the ones you need to make sure you have the reserves for. In theory, your CECL methodology should take into consideration just about whatever the economy is going to do, because you have your Q factors, you have everything else put in place. So how do you know if your CECL model is generating the appropriate amount. Well, you know, you can see that it's most of the models give you an idea of the percent of loans that your ACL is that was calculated through CECL. I would say that that amount is going to be pretty close or similar to what you have now. Like you shouldn't, unless you're grossly underfunded right now, your CECL model shouldn't change like hugely. I would imagine. You're still looking at between, depending on how risky you are, between 1.1 and 1.35% of your portfolio as being a reasonable amount. I don't know that that thought process has changed much. It's more how we get to that point. So if you're showing, your CECL model is showing you at like 0.85%, you're going to have problems. That's not where you want to be. That's probably too low unless you have a, I mean, I wouldn't be comfortable with that low, but if it's showing that you're at like 1.8, you're probably over reserved and need to go back and look at that model and see what it's doing and why that's happening. Do you guys know where you're falling right now with your CECL? Like your percentages? Okay. 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 Well, it depends on the portfolio. Like if your charge off history for the last 5 years has been almost nothing and you have strong credit quality and, you know, good credit administration, I think you could easily support that. If you are in a high growth mode, you have higher risk type loans, you have more past dues and non-accruals, you're probably going to want to be at the bigger end of that. So I think there's no right or wrong answer, but I think if you guys came in and you had that no charge off history for 5 years, very limited, you know, really good everything, and you came in at like 1.6, you want to look at that model and say, is this really accurately reflecting what's going on here at the bank? Because the issue is they're like, well, what if the economy changes and we have to fund the allowance in, you know, 6 months? It's going to have to come through the provision. Like you are going to have to do that anyway. Like if the economy changes and loans start going bad, you're going to have to make a provision to account for that. So I think it's like a lot of the banks are trying to game CECL to predict the future and pad. And I can tell you, like, being over, everyone's like, well, we could just over reserve. No, you can't really over reserve because then the examiners get irritated with you. Like, why are you just putting a bunch of money in there that's not justifiable? And my question would be, like, if your reserve calculation says that you should have, you know, 1.5 million in there and you have 2 million in there and your answer to me is, well, we're worried about the economy, I'm going to say, then what is wrong with your model? Like your model does not accurately reflect what you think is going to happen. So is your model valid at all? Because it clearly doesn't do what you think it should be doing. And then the response is, well, I don't want the model to say that we need $200,000. Well, then you can't, or $2 million. Well, you can't put $2 million in there. You can't.
pick a methodology that most accurately reflects and roll with it, because make sure you have good credit administration, make sure that you are identifying those problem loans and being realistic about it, because lenders are the worst when it comes to that. I love lenders, but everything is rosy and happy. They don't want to admit that there's a problem with a loan. Those things, like, that's probably the biggest key right now, is going into that day one adjustment, is making sure those specific allocations are accurate and good and reflected in your calculation, because those are the ones that are going to hurt you. The examiners come in and say, you know what, this loan you have as performing, we think it's substandard. It's $1.2 million loan. You have to, your provision is, you're under reserved for $300,000. Now you have to fund the allowance. That's how that's going to happen. It's not going to be those allocated pools. Okay, let's keep. I'm gonna be so happy when we cannot talk about CECL anymore. You know what the funny thing is? I don't even think that, I still think there's a whole bunch of banks that never figured out the old allowance model, and now we're starting a new one. It's gonna be like Groundhog Day. Just gonna have to start all over with all these conversations. So one of the changes is, if you are in a merger and there are loans with credit quality issues that come over as purchase credit impaired loans, the name of those for under CECL is changing to purchase credit deteriorated. So they're not going to be PCI anymore. They're going to be PCD, which I am probably going to mess up every time I say it. I'm going to call them PCI. But these PCD loans are essentially going to be treated the same on the books, but how we report them on the call report is going to change. So currently they get net against the loan category and they're reported in RCB. So if I have a mortgage and it's $100,000 mortgage and there's a $5,000 discount on there and then a $10,000 PCI on their reserve, I'm going to report that as, I think I said discount. I'm going to report it as 100,000 minus 5 minus 10. So what, 85,000 is what it's going to get reported as of 12/31. Going forward, that PCD credit that's associated with that loan is no longer going to be net against the loan. It's going to get reported on line RC as part of the ACL, which is probably where it belonged all along. I don't know why we netted against the specific loan, but it's really it's truly an allowance for that specific loan. So it makes sense that it would get pooled with the allowance. Now, it is not includable in the allowance that's eligible for equity. So when we go to RCR Part 2, we have to back this PCI amount out, which is why you're starting to see why we need so many general ledger accounts, because they're all getting reported in different places. Okay. And you might not have these now, but if you buy a bank, you likely will. And my prepare the call report version is, I would not want, don't find any PCD loans. I don't want to deal with this. But then the other accountants are like, well, you kind of want PCD loans, because if you merge a bank in, the allowance gets credited back to the bank, but these loans, the full amount of the loans that you purchase go into your pools. So now you have to make a provision to account for the new loans that come in. There's been a couple of clients that are surprised about that. They're like, can't we just run it through equity? No, you can't. You have to run it through the provision. But the advantage of bringing these over as PCD loans is
these loans don't get included in that pool. So they have specific impairments through the PCD and they don't get included in your pool. So you don't have to make a provision for them. All right. So RIC is the desegregated data on the allowance for loans and lease losses. This only needs to be filled out if you're over $1 billion. So you guys are filling this out. I think we are, hopefully we are. So this is an interesting one. So this desegregated data is I put it on here because if you are using, we waited till the very bitter end, like a year before CECL was implemented, and then the Federal Reserve came out with a model that is super simplified for small banks. It's called the scale method. And part of the scale simplicity is the government goes in, the FRB goes in, and they figure out the factors that need to be applied to each of the loan pools. And that way you don't have to do any sort of like analysis or regression or anything like that. You just go to the Federal Reserve website and pull down the data. Well, this is where the data comes from. So if you are one of these banks in June or December and you're over $1 billion, you should be reporting your the total amount of loans you have and the allowance that's associated with them. So the interesting part of this, the categories are construction, commercial real estate, residential real estate, commercial loans, credit cards, other consumer, and unallocated, if any. These are not, there's no specific guidance on what exactly those look like. They're whatever your allowance thinks they are. So for example, construction loans, these could be commercial and consumer. Commercial real estate could include CRE and one to in multifamily. Like there's no specific, this is what this should be. I mean, obviously they should be reasonable, but there's some leeway there and it's not a perfect system. So this is what the smaller banks are using then to be able to calculate their model using the scale method. And you just go right to the FRB website, you pull it down. The disadvantages, so I'm doing this for I'm using the scale method for a $50 million bank, which is super tiny. They're using the loss and the allowance information that's coming from $1 billion bank, which is likely more than what they're going to have, but it's a practical expedient they provided. Okay. Okay. Oh, this was my PCI example, PCD example. If you do get into a merger situation, this is going to be really valuable for you. But if you're not, it's probably not super interesting. So it's here if you need it. Okay, so where to put things on the balance sheet. This is going to change a little bit too. So if you have a reserve for held to maturity, that gets net here on 2A with your with the held to maturity securities. So it's going to be held to, so if you have $1 million worth of held to maturity securities and a $200,000 reserve against them, you're going to report $800,000 as your held to maturity. Same thing for the AFS. So you're gonna, whatever your fair value is of your held available for sale, net of the reserve. And then your allowance for credit losses is going to include the PCD, which it currently does not. And then we still have our reserve for unused commitments. That's gonna get reported on our CG as allowance for credit losses on off-balance sheet credit exposures. Oh, okay. So what the heck was I doing here? Okay, so this is trying to tie these out because my biggest concern with all of what's going on with Cecil is there's not a clear line. Like you can't say this plus this equals this. It's this plus this plus this plus this equals this. And that's what's going to make this so confusing. So if we go back to the changes in the allowance, so that's RCB part 2, and we go down to the allowance, the reserve amount for column B, which is the held to maturity, that reserve amount net with column A of RCB is going to equal RC2A. Following me? Same thing with the available for sale. So we have to take the available for sale fair value plus the net with the provision gets us RCB 2A or 2B, RC 2B. Okay. I'm gonna have a busy quarter next quarter when I have to update all the workbooks to have all this craziness in them. Okay. RCC and RCN, TDRs will no longer be reported after the adoption of CECL. So that is wonderful. And then I think this is the last. Nope, it's not. There's more. The amounts that are includable in the tier 2 capital, I just kind of put another one here. Any of the reserves, just not the PCI. So the PCI is included in the reserve on RC for the loans, but it's not included here. Yes, and the 1.25 still applies. So anything under the 1.25. But now you can add all of these to that amount. And that's to calculate tier 2 capital. And that's just a visual representation of where that goes. Okay, any questions about any of this stuff? So from a call report perspective, TDRs are going away. It's no longer going to be reported. And we'll pull up, when we go through this, I want to pull up the supplementary instructions just to kind of show you guys those to begin with. But for call report purposes going away. The problem is for financial statements, there's going to be additional disclosures. And the additional disclosures on the financial statements are going to be what's going to cause it's going to be way worse than what we had to put on the call report. Because that's how that works, right? Like we're going to make life easier for you, but we're going to make it much harder. And I don't recall off the top of my head, but I believe there's the way that you have to report them is like if it was in compliance for a year, when it went out of compliance, what pool it was in. So it's not going to impact the call report. It's going to impact your financial statement disclosures. Yeah. I can see if I can find something for you.
I mean, for instance, going away, but
Yeah, for the call report they are, but not really. You're still
Or
gonna
for the
need to
bank as a
do
whole.
reporting. It's just gonna look differently. And it's gonna be more detailed and more granular than what we're doing now for the disclosure. And I think I can email me, and I think we have a sample, like we found one somewhere that is a,
could you say
yep, your 10Qs, your annual reports, yep, all of the Ks, yep. Those, that's where it's gonna be. Yes. But this will be easier.
my part?
So if you're under 500 million, you should be all good. Okay. Transition provision, 3-year phase in. So, my God, I think I've explained this to the same bank president 4 times in the last 3 weeks. So I've had practice. This is a tough, like, okay, so I think that when I first read this, I was like, okay, what the heck does this mean? How does this work? This is very similar to any other call report transition provision when it comes to capital. It's where we are given the ability to essentially continue to recognize a portion of what we did on our balance sheet for the purposes of calculating capital. So in this case, we have to do the day 1 entry on our balance sheet. Our allowance is going to reflect the correct amount. Our undivided profit is going to reflect the correct amount. When reported on our RC, it's going to look like our balance sheet. However, on our regulatory capital schedule, we're going to be able, if we choose to do this, we don't have to feel the whole brunt of that adjustment all at one time. So why would we want to do this? If I was a bank and I was using the CBLR, and I was at like 9.1%, and my allowance day 1 entry kicked me under 9%, I might say, you know what, I'm going to use this transition provision to smooth out the impact of this day 1 entry and keep me above 9%. I'll explain it. So let's assume that we had $100,000 day 1 entry. Our balance sheet retained earnings was after we ran the day 1 entry, our balance sheet retained earnings was 500 million or 500,000, let's say 500,000, because if we use the transition provision, we can add 75% of that back for 2023. So with that being said, we would actually report as equity 575,000, even though our balance sheet said 500. No, that's a good question. It's 75% for all of 2023. So you get to just add back 75%. And then in 2024, it goes to 50%. So for the whole year, 2024, you add back 50. And then 25, and then steps down to 0 in 2026. I honestly think, Danielle, that's the struggle that everybody was, and when I first looked at this, I'm like, these numbers don't tie out. They don't match. Yeah, like how does this match? And you got to get past the fact that you're not trying to tie out to like the full amount of the $100,000. You're just getting to add back 75% of it, and then it makes a bunch of sense. You're welcome. Okay, so if you choose to go this direction, you would add the phase-in amount to the retained earnings on RCR Part 1, and then you would enter enter 2 that you're electing to use the 3-year phase-in.
So now they know that you're doing that. And this amount here, your retained earnings, isn't going to tie to your balance sheet. Okay. That's all my CECL slides. Any questions? Anything else you want to talk about related to CECL? Okay, I want to do something really quick here. I want to find a place because this I think is really important. I want to talk through, let me, my ability to use technology is frightening. All right, let's see if I can do this. Did it change? Is it going to change? Hold on. Screen share. Hold on. Stop sharing. Apparently that's not an option. Oops. I want to show you this. It's not letting me change it. Hold on a second. Gosh, I hope this is worth the suspense. My pop. Okay. So let me share this on here. Okay. Okay, so this, here's me now. Get rid of me. This is the FDIC resources page on the FDIC website. So this is my go-to page for all my call report information. And it's under Home Resources Bankers Call Report. And the reason I like this is it gives me all of the current quarter's instructions that are up to date. And whenever I look at instructions for the call report, I always use the most current version because things move quickly. There's clarifications. I never want to go back to a prior quarter if I don't have to. Now, that being said, again, we talked about this morning, we might not have the March 31st until April 25th. So we might have to look at the December, but ultimately I want to look at all these because as I scroll down this at the very bottom, there's going to be information here about changes. So I'm not really worried about the calculation, but this one right here, FIL, this is something you get emailed every quarter. So if you're a call report preparer, you're going to get this email to you and it's going to go through what is changed, what's up to date, what dates are important, contact information. Most of the time, it's just pretty much the same information, but if there are any sort of specific changes, they'll be documented down here. And there's also a link to the supplementary instructions. So those will come on here. The supplementary, I cannot say the word, the supplementary instructions, this is my first stop every call reporting period. This is what tells me everything I need to be aware of that is a call report update or an accounting update, more importantly. So to your point, when accounting rules change, how do you know what's happening and what the impact is? Well, supplementary instructions are the answer to that. So let's just jump in them and kind of walk through. I think I can make them bigger because, all right. Okay, so there's always going to be at the very top, any topics that have been removed. So accounting for hedging and accounting for leases have been removed. But if we go all the way to the bottom of the report, it usually gives us everything from like the history, like some of these go back to, yeah, 2006. So the major accounting changes and how they impact the call report are usually found down at the very bottom. Other reporting matters. Okay, let's go back up to the top. So then it gives us some general information. It gives us a lot of the stuff is the same every time. Here's the CDR, here's information. These are the software providers of the call report software through the CDR. This is interesting because I thought this would go away, but it hasn't. And I'm wondering if it's going to become actual instructions. During COVID, when people weren't meeting in person, we still had to attest to the call report. The problem is we couldn't get wet signatures because people weren't meeting in person. So what this does is it outlines a method that's acceptable to the examiners and to the regulatory bodies for having it attested to by using email or other electronic signing. So this is kind of nice to have in case you can't get directors in person, you can follow these instructions. SEC Bulletin 121, not everything's going to apply to you, but these are crypto assets. I'm guessing no one in this room is doing crypto assets at this time. You want to hold off till we figure all that out. Wait till my bank in Ann Arbor does it. Okay. Accounting for loan modifications to borrowers experiencing financial difficulties. This is our TDR. So it kind of gives us some background and information. It gives us the accounting references, and these are still going to be for early adopters because this is 12/31. March is going to look different because everybody's going to need to adopt. But this is the part that I want to draw your attention to. Upon adoption of this standard, TDRs would no longer be reported in these memorandum items. No, but I will say this did not come out until midway through the year. So this is relative. I think September may have been the first time we saw this. I know it wasn't this was recent. Okay. So I'm expecting based on this, when we get the March instructions, we're going to have some good clarification around the TDR reporting for the call report to say, and I'm curious what it's going to say, because is it going to, is it just going to eliminate that part of the call report? Because if we don't need to report there and everybody's adopted CECL, why would we still have those items? But
Utilize Fed Reporter, and we usually get notified reporter being updated a week before the report.
yeah, and I feel like I feel for a lot of these software companies because they're probably ready to go, but they can't press any buttons until they get final instructions and information from the regulatory agencies. And I don't know why it takes them. I would expect, like, honestly, the instructions for preparing the March call report should be available April 1st at the latest, really. So I don't know. And then what ends up happening with Fed Reporter is you end up getting like something toward the end of the month with a bunch of updates and, you know, this is all the things that have changed. This is all the glitches. This is all the stuff. So I don't know. I know historically, even though we should be getting information sooner than later, that's not always the case. And I don't know what the hangup is because obviously they know about this. They've known about it for a while. Like, why isn't it out there now? Okay. Reference rate reform. This continues to be on the list. It's been here for a while. This is the LIBOR going away. So, and honestly, one of the things I do with one of my banks, and this was a recommendation of their from their examiners, is to have just a meeting once a quarter prior to the call report with everybody involved in the preparation, where I go through the supplemental instructions and say, okay, this is what's going on. This is what's changed. Does any of this apply to you? Do I need to know about any of it? And that's been really helpful. And then we document it. We put it in an email. It goes to the CFO, the controller, the internal auditor that works with them. And then it's documented that you've reviewed all the changes and that, you know, you have a handle on what's happening. Credit loss and financial instruments. This is CECL. This has been on here for a while. Again, the other reason I like this here is so I can see that if I need to go to resources that are regulatory or accounting that are very specific to what I care about, there's links within these documents, and that's probably the best way to find those resources. Because if you do a Google search, you go down a rabbit hole and you never come out. So being able to get like, okay, I can just click right in here on the interagency policy statement and know exactly what I'm looking at. These are all the ASUs I need to be concerned with and so on. Okay. Amendments, and then other reporting matters. So, and some of these still, irrelevant. I do frequently go in here and pull out some of these and, you know, reference them. This is my first stop if there's any questions. And it is interesting that there is sometimes different information in the supplemental instructions. If you go to the actual instructions for RC and RCN, it doesn't have the information that's in here. I lost my mouse. I can't do anything. So I do think this is probably the best, most concise, easiest place to go for any, like, first stop every quarter, scan through this, make sure you're on top of anything that's changing. This is going to be more valuable than anything else you do. Okay. Let me grab back to my there we go. Okay. So that's the link here, the FDIC link. I think this is just really
best thing to look at. We talked about equity securities, mortgage servicing rights. These are all in your paperwork. It's just more detailed information if you need to reference back. Time are we at? We have a few minutes still. So I do want to talk about documentation to retain with your working papers. And this is obviously not 100% inclusive list, but I do want to talk about the whole process, because again, when we talked this morning, what you're preparing is really going to be used by auditors and examiners. So you want your documentation to be as simple and concise and easy to follow as it possibly can be. We're not where we were 10 years ago, where the person coming in to look at your call report has extensive experience. These are probably going to be newer examiners, possibly even training. It feels like every bank I talk to, like you were talking about them training at your bank. I swear every bank I talk to says they have people training at their bank when they come in for the exam. So I think there's a lot of younger people that aren't quite as seasoned and experienced. So that's one reason to have really good work papers. If you can have somebody with basic knowledge open up your documentation and be able to follow and understand what's going on, it's going to make your life easier in the long run. The second part of that is if you have a good, solid structure, it's going to go a long way for one of the things that I'm finding with a lot of the banks, I'm working with a couple banks right now that are under MOUs, MRAs, and the reason is because there's nothing fundamentally wrong with their call report. Their call report is just fine. The information reported is good information. The problem is the examiners couldn't figure out what was going on because of the way it was documented. And second, because they couldn't figure out what was going on, they were concerned that there wasn't going to be a good way to transfer that data when that person who understood whatever chaos was happening left. And those were valid. I've heard this repeated a number of times. So one of the things that I really kind of want to implore all of you to do is to create some kind of if you don't already have one, structure where really if Jessica wasn't coming in or she won the lottery and moved to like an island and lived happily ever after. Well, I mean, it used to be got hit by a bus, so we've upped our game up to at least won the lottery. But if Jessica wins the lottery, is somebody going to be able to pick up Jessica's work papers and reasonably understand what's going on? We were kind of talking too, like a lot of the smaller banks don't have a true backup. And as an auditor, when I audit the call report, one of the things we look at for internal controls is there a backup? Is there a trained backup? Well, the answer is usually going to be no, because what are the odds that, a $300 million bank has 2 people skilled in doing a call report functionally, like they can pick it up and do it. So when I look at the work papers, I can say, okay, you know what? I can look at what's going on here and reasonably think that I could come in and do a call report. I mean, obviously it wouldn't be like, the teller coming in, and somebody who knows what they're doing could come in and do your call report. So as long as you get to a point where that's happening, I think you're in really good shape. But anytime there's any sort of adjustments that don't have like any sort of rhyme or reason, or you've done something, but 3 months later, when somebody asks you about it, you can't remember what you did because it was 3 months ago and it was chaotic. I know that that's much easier said than done because I still do call reports, and I have to say, like, making sure that I'm disciplined to be like, okay, that's what that is, documenting it. It's so much easier for me to tell other people to do it. But especially if it's going to be audited or looked at by the examiners, you want it to be in really good shape. You want to have all the support, because the reality is, even if it's not examiners, if it's your auditors,
if you send me everything I need to audit your call report and I could just work my way through it, it's going to take me way less time than if I have to keep going back and forth and trying to get information. And when it comes to audits, time is money. So it's going to be less expensive. It's going to be easier in the long run. There's a ton of advantages. So I kind of just wanted to talk through some of the reports. And especially like you guys, it's interesting because I do have some banks where they do it like yours, where different areas do different things. And one of the things that ends up happening with those situations where it's like collected in one place, and I don't know if you guys do, I'm not specifically picking on you, but this bank that I was working with, the person collecting it, she didn't collect support to go with any of the things she was given. So they would just give her a schedule and say, here's RCL, and not really provide anything to support that. And then it was like, okay, when I ask for RCL, she just sends me like handwritten numbers and I don't know where they're coming from. So then I have to go back to her. She's got to go back to her people. They have to go figure out where it is. So like having like a standard of what gets included in those files and what is the appropriate support is going to be probably a lot easier in the long run. And then you could go back to, and it doesn't matter, like, do you guys, does anyone keep paper yet still? Paperwork papers? You're shaking your head. Yeah, we have paper. The paperwork papers are fine. There's nothing wrong with them. But yeah, it's no problem keeping electronic. If you want to use an Excel workbook, I like sometimes I'll embed files into the Excel workbook. Sometimes I'll just take a snip and stick it in there and like put a box around it. So, you know, next time I know, and you guys have the advantage, you work at the same bank every time. So your reports aren't going to change. But I sometimes work with 3 or 4 banks every quarter. So I'm like, I don't know what is the report number we need? What is it that comes from this report? So like just putting a snip of that report or that report number in my work papers, something as simple as that is so much nicer because then, okay, all right, to get average assets, I pull report, you know, AVG 250 and it comes from here. And that's super helpful. The other thing I would strongly suggest, not so much for your bigger groups because you guys have more people involved in the process, but the smaller banks, making sure if I come in as an emergency person or anyone else comes in as an emergency person to do your call report, I can do the call report. I know I can do this in my sleep. What I don't know is like where your information is on your core system, what it looks like. I mean, if you have Fiserv or Jack Henry, I could probably find it, but even then there's multiple versions of that. So I would say at very minimum, putting together like a source list of all the documents you need to prepare the call report, and then having somebody other than you, the preparer, pull those reports, which I know is going to be sad for anyone who prepares the call report to delegate getting these documents to someone else. That'll be the worst part for you. But the reality is that means now there's 2 people in your bank that know how to find these documents. And if you're not there, then somebody else can at very minimum pull the documents to be able to say, okay, we have a place to start. Especially, oh my gosh, I got called into a bank one time to do a call report and they're like, the person who did the call report for the last 15 years left. We don't even know we've never walked in her office. We don't know where the work papers are. They knew absolutely nothing about, like, they didn't even know what a call report looked like if it was sitting on the desk. So I had nothing to work with. So I went into the bank, you know, plunked around, figured it out. They had a weird core system. And it turned out there were some reports that we could only get on the 1st of the month. And because we could only get them on the 1st of the month, we were never going to have good data. Like we were going to have to work into whatever numbers we were reporting because they didn't exist anymore. So just making sure if there's situations like that where we have to pull this report on the 1st of the month. And if there is reports that have to be manually pulled on the 1st of the month, call whoever your core service is. I'm betting they can have that automatically ran and put in cold storage for you. because it's 2023. I don't think there's very many things that can't be done like that. And for the amount of money you guys pay for these core systems, I'm sure they can do that for you. And the other thing is, when you're looking at reports for the call report, I would say that just because, say you've been doing something manually for years, and I'll pick on average assets because that's the one I see the most frequently. All I hear is we don't have average assets. We don't have an average asset report. Like, well, you're on the Fiserv core. You do have an average asset report. You don't have it turned on. It's there. You don't have it turned on. So if I give you the report number, you can call Fiserv, they can turn it on for you, and then you will have it going forward. So just don't make the assumption that just because you don't have something that it doesn't exist. It's likely it does. They just don't turn every report on for you. You might just have to ask, do you have a report that gives me this information? And they'll say, oh yeah, or do you have this report number? And then they can get it set up for you to have that report run. Ideally, anything from the core is better than anything manual. It's tricky though, because sometimes an Excel spreadsheet is so much easier to work than a document, but at the same time, especially for you bigger banks that are fiducia or financial statement audits or even publicly traded, you have to vet that information. So if you have a spreadsheet, you have to do something to tie out the totals on that spreadsheet to actual reports that are not reproducible, just to, make sure you have the whole population. Okay, what else do I have here? Just some general documents, help you start a list if you wanted to. Technology and automation of call reports. This one, I struggle with this one because, again, I am the efficiency process person. And in theory, like the logical thing to do would be, let's interface the whole call report. Let's just tie everything in, press a button, it'll do it for us. That's not the reality. You're looking at me like, oh, that would be fun. That's not the reality of preparing a call report, because I almost feel like even if you did press a button, you'd still have some responsibility to go back and check everything. So and I also know too that I had this one bank, they did a core conversion to Jack Henry. Jack Henry went through and set up this elaborate interfaced upload that they pressed a button and it did what it was supposed to do. And then the bank, of course, it didn't all transfer. There were adjustments that had to be made. There were manual changes, and he would run those through their program, and they got embedded in this upload sheet. And then when the examiners came, the examiners are like, where'd you get this number? This number here does not tie out to your core system report. And he's like, I don't even know anymore. Like, so they had to take a step back and unravel everything and move back to like a system where they could see what was going on. So if someone asked them where a number came from, they were able to do that. I think there's a good hybrid way to, I think you can, depending on the technology and the people you have available to you. I mean, I can do a call report on a spreadsheet for a $400 million bank that sometimes does really weird stuff that I'm not prepared for in probably 5 hours start to finish. And that's using a spreadsheet and, Excel balance sheets and income statements and just tying everything together. So I feel like there's still efficiency if you use the right tools. Having it specifically interfaced doesn't necessarily mean it's more efficient. It seems like it might be, but it could create more issues in the long run and more work in the long run. So you probably have the majority of the technology you need right now to leverage to be able to make a process work really, really well and make it very transferable. Questions on that? Just some stuff we kind of talked about: contingency planning, mergers. Those are quieted down. but I think they're gonna start back up at some point. Not because banks want to buy other banks, because banks need to be bought. Like, I think that's what's gonna happen. We're gonna see a lot more banks that are gonna need, they don't have anybody to operate them or to continue operations, so they're not gonna be able to remain independent. So they're going to need to be acquired by somebody, which I think is gonna be interesting, because now we get back to a lot of this merger, the merger accounting, the merger entries, the pre-merger, post-merger. I actually we have an investment banker who works on the merger side at Wifley, and I usually get involved after the fact when they're like, I don't know how to do my call report. Somebody please help me. So I told him, I'm like, you need to get me involved in this process much earlier. So like we can help the bank set up what general ledgers do they need? What spreadsheets do they need? What tools do they need? What training do they need? All of that ahead of time, so you're prepared and you're not panicked when you're trying to figure out all this new information. Because there's a good chance at least one or more of you in this bank is going to be involved in a merger in probably the next 2 years. All right, any other questions? Oh, I have a thank you. Comments? Anything you want to talk about that's related to call report that I didn't already talk about? You're like, we're not talking. We're so close to the end right now. Well, if anyone has any questions, you have my contact information. I also have business cards. If you have a specific question, you can send an email over to me. I'm more than happy to answer whatever questions. I always tell people, don't chase your tail. If you're asking me a question, aside from your question, there's your derivative question. I think there's a good chance I've already answered it probably multiple times, and I could help you in 5 minutes and keep you going on your way instead of trying to read instructions forever and running in circles. I mean, try them first, obviously, but sometimes you just need a voice of reason. And I'm happy to help. All right. Thank you, everyone. Have a good rest of your afternoon.